Good morning, everyone. I'm CS Saurabh Arora. Hope each and every one of you is keeping it safe. So, the topic for today is risk assessment and internal control, which is chapter 3 of our advanced auditing and professional ethics. So, we'll dive right in. So, the scope and coverage of this lecture is in-depth study material we have tried to cover over here, and no additional material is required to study this chapter. If you go through these slides, this will be enough, and you can refer the study material as well, basis which these slides have been made. The second coverage is practical examples for easy understanding. So always quote practical, relevant examples to demonstrate conceptual clarity and also to demonstrate that you have undergone internship. The third is practice questions and solutions to help in internalizing the concepts. I have mentioned various practical questions and solutions over here through which you can cement these concepts that I'm going to tell you. Then the keywords underscored or highlighted for a quick glance through. So please understand that the concepts you should learn these concepts and understand these concepts using the keywords and then use them for revisions and write them in exams for good marks. So we do not expect that you cram each and every sentence of this study material or the standard on auditing. What we expect is that you understand these concepts clearly through the use of keywords, and then you write down those keywords in the exams as well. So that's what we expect. So we are starting with risk assessment and internal control, which is chapter 3 of advanced audit. So the learning objectives of this lecture are that we'll try to understand the concept of risk-based audit. So nowadays, the companies do not expect a normal traditional audit from you. They need risk-based audit. Even the statutory audit has to be risk-based audit. Then the internal control, we'll try to understand what are the internal controls and risk assessment. Then we'll try to understand the components of audit risk and internal controls. We review the system of internal control. How can we do that? Know the internal control system, its nature, scope, objective, and structure. So we'll do it thorough. Then gain knowledge of reporting to clients on internal control weaknesses. It is not just important to understand the internal controls by the auditor themselves. It is of no use unless we report to the clients. And how do we report it? We report it according to the framework of reporting of internal controls. And what is the framework of reporting of internal controls? This has been mandated by the institute, and this has been mentioned by the institute in the standards on auditing, that we are going to discuss it today as well. So these are the learning objectives of this lecture. So we'll start with the risk assessment. So first of all, we'll deal with the risk. This might sound like a very trivial question, that what is risk, but please understand that this question has been asked to me also in the interviews, and many of the candidates are unable to answer even this question, that what do you mean by risk? So risk is a possibility of undesirable event. It's not a probability, it's not a certainty, it's a possibility of undesirable event. It is something undesirable and not desirable, and it involves uncertainty. Until there is uncertainty, there will be no risk. So example of risk, example is on 31st July, after filing all the ITRs in the office, you reach your home and order a pizza. As soon as you open the box and are about to take the first bite, a guest walks in. So now an undesirable event has happened. Now there's an undesirable event and uncertainty that you might have to part away with your favorite snack. So that's an example of risk. That's a very personal example of risk, and you don't need to quote this in the exam. What is assessment? Assessment is evaluating and estimating. So risk assessment means assessment of the level of risk in various business processes. What are the business processes? Accounts payable, account receivable, manufacturing, production line. These are the business processes. So risk assessment means assessment of the level of risk in various business processes, organization structure, specific concerns of management and the audit committee. Sometimes there would be very specific management concerns. When they'll engage you in the engagement letter, they'll write specifically. So these are our specific concerns that you need to look into while doing the audit. So that will be also included in the risk assessment. And other external areas, for example, regulatory environment. What is the regulation environment in the country, in the geography that you are operating in? Business environment, for example, Entry of Reliance Jio in 5G has wiped out almost all the competitors. And then the environmental changes, for example, COVID-19 pandemic. I've been told that you are aware of this. So risk assessment means assessment of the level of risk in various business processes, organization structures, specific concerns, and external areas including regulatory environment, business environment, and environmental changes. So what I have highlighted over here in blue are the keywords, and you need to remember these. But you can leave out the examples. You can quote different examples as well. But whatever I have mentioned otherwise, you need to remember these. So risk assessment helps you analyze business dangers which are internal and external. This is not the definition. This is just for the understanding this chart. So we'll move on to the next slide. Now we'll come to the audit risk. So the audit risk is the risk of expressing an inappropriate audit opinion on financial statements that are materially misstated. Please understand that this is materially misstated, and this is not something trivial. There is no some trivial error in the financial statements. We are not commenting upon that. We are not going to there. There could be some trivial error, but it will not come under audit risk until it is material. So audit risk is the risk of expressing an inappropriate audit opinion on financial statements that are materially misstated. What is risk of material misstatement? It is the risk that the financial statements contain a material misstatement before the start of the audit. So not until we have started the audit, there exists some risk of material misstatement. So as you can see in this chart, in this flow chart, audit risk is divided into detection risk and risk of material misstatement. Detection risk means after the conduct of audit, there still lies some material misstatement which the auditor has failed to detect. Then there is risk of material misstatement. There are two types of risk of material misstatement: inherent risk and control risk. Inherent risk means the risk that is inbuilt in the financial statements. And the control risk means that we have applied the internal control system. We have applied all the internal controls that we have, but still there is some risk of material misstatement in the financial statements. So these are the two types of risk of material misstatement. We'll deal with their definition now. So risk of material misstatement is the risk that the financial statements contain a material misstatement before the start of the audit. So since detection risk is the after the audit, the risk of material misstatement is before the audit. Inherent risk is the risk posed by an error or omission in financial statement due to factor other than a failure of internal control. Inherent risk is because of factors that are other than internal controls. This is inbuilt in the financial statement. Please remember that inherent means inbuilt, which already exists, which is because of the nature of financial statements only. Second is control risk. Control risk means the risk of material misstatement which is not prevented, detected, and corrected on a timely manner by internal control system. The risks which are not prevented, detected, and corrected on a timely manner. If they are not getting corrected on a timely manner, then there's no use of applying those controls, and so there will be some control risk. We'll come to their examples in the next slide, so you don't need to worry about that. Here we are just reading out the definitions. So inherent risk we have done, control risk. Detection risk is the risk that the auditor will not be able to detect material misstatement. This could be because there is no material misstatement in the sampling that the auditor has picked up, or there could be some other reasons as well that the auditor missed to detect the material misstatements in the samples that he chose. So audit risk is the factor of detection risk and risk of material misstatement, as we can see from this chart as well. And in turn, risk of material misstatement is a factor of inherent risk and control risk. So if we have to come up with a formula for the audit risk, it will be audit risk is equal to detection risk multiplied by risk of material misstatement, which is audit risk is equal to detection risk into inherent risk into control risk. So for example, if we have to reduce the detection risk, if we have to reduce the audit risk to the minimum, then we'll have to reduce either the detection risk or the inherent risk or the control risk. But what is in the hands of the auditor? Auditor can only reduce the detection risk. Auditor cannot reduce the inherent risk or control risk because this depends upon the management. So auditor will have to either increase the sample size or get more involved in the audit and do more substantive audit procedures to reduce the detection. That's all in the hands of the auditor. So we'll come to the next slide. So audit risk, again, I'm giving you certain examples of these risks, and I'm being repetitive over here just so that you can understand these risks very clearly, because these are very important in our understanding of this chapter and also of the auditing subject. So audit risk is equal to inherent risk into control risk into detection risk. And the definition of audit risk, which you have to remember, the audit risk definition, inherent risk definition, control risk definition, and detection risk definition. You need to remember all these definitions. And these are not very typical definitions. These are just simple statements, simple plain English statement. No statutory language is used over here. So audit risk is the risk that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. Now, audit risk is a function of inherent risk, control risk, and detection risk. Inherent risk means before consideration of related control, material misstatement of class of transactions, account balances, disclosure, or aggregate of above. You have to remember this, that these are the four elements in which the risk can occur. First is class of transaction, second is account balance, third is disclosure, and fourth is aggregate of the above. So we'll aggregate all of that, and if we see that it is material, then we'll say that there is inherent risk. So inherent risk could be because of the nature of the financial statements. Example, complex and voluminous transactions. If there are multiple complex transactions, if there is a high volume of transactions, then but of course there are risks that there could be some error in the financial statements, and if we aggregate all those errors, it could turn into something material. Then there could be some quick changes in the accounting policies within short time span. This could result in some error. Then financial values based on judgments and estimates. For example, provisions, for example, hedging, losses, etc. in certain cases in which we have to make our judgments and estimates. Then human errors also exist in the preparation of financial statements. Second is control risk. Control risk means that we have applied the internal control system and still there are some material misstatement. So after the internal control system has been applied, material misstatement of class of transactions, account balance, disclosure, or aggregate of above. So these four elements will stay intact in all these risks, that is class of transaction, account balances, disclosure, and aggregate of above, which couldn't be prevented or detected and corrected in timely manner. For example, faulty vendor selection process. So what we are saying is that the vendor selection process already exists in the company, but it is a faulty one. So the control system is there, but it is not able to prevent the incorrect, inappropriate vendor selection. Third is the detection risk. Detection risk means that the auditor has done the audit and still there exists some risk of material misstatement. So after substantive audit procedures have been applied, material misstatement of class of transaction, account balance, disclosure, and aggregate of above. For example, fraud in out of sample transactions. So if we have selected, let's say 75% of some transaction, but if there's some fraud in the remaining 25% of transactions that goes undetected, we'll call it detection risk. So we'll quickly go through it again. Inherent risk, control risk, detection risk. Inherent risk means which is inbuilt there in the system. Control risk means that we have applied the internal control system, but still some material misstatement exists. And the detection risk is that after the audit has been done, there still exists some material misstatement. So these are the three types of risk. We'll come to substantive procedure. How do we jump onto substantive procedure? Because it has been mentioned over here that after substantive audit procedures have been applied, there exists some material misstatement. So what is substantive procedure? An audit procedure designed to detect material misstatements at the assertion level. What is the meaning of assertion? Can any one of you tell me that? Let me check your comments. Can any one of you tell me what is the meaning of assertion? You've been reading about assertion since your intermediate. Does anyone know what does it mean? So assertion means claims by the management, and claims and representations by the management, and claims and representations are not merely in the form of management representation letter or the discussions with the management. Claims and representations are also in the form of financial statements. When a company says that I have $1,000 of building in my books, then that means that that building exists. This is the claim that company is making. And the other claim that the company is making, that its value is actually $100,000. So these are the claims and representations as well. So assertion, that is the assertion. So an audit procedure designed to detect material misstatements at the assertion level. And substantive audit procedure comprise test of details. Test of details of what? Of class of transaction, account balances, and disclosures. I have told you to remember these three elements always. And then the substantive analytical procedure. Substantive analytical procedure means budgeting, budget versus actual, and comparisons in the industry versus the results of the company. So, for example, auditors may perform substantive analytical procedure on interest expense of borrowings by multiplying the average outstanding balance of borrowing with the average interest rate. This could be one of the substantive analytical procedure. The other could be performing test of details on expenses by vouching expense transactions to support documents such as invoice, purchase orders, receiving reports. If you have done some audit, you would be very familiar with these test of details, substantive analytical procedure. You might not be familiar with these terms, but you might be familiar with the processes of these auditing. Another example is that when we are performing audit of cash at banks, auditors usually perform direct bank confirmations to ensure the existence of cash balances. So these are at the assertion level. The bottom line is that these audit procedures are at the assertion level. For example, we are auditing the cash at bank, then we are confirming whether this much of cash at bank actually exists by confirming from the bank. So we are checking the assertion of the management. Similarly, the interest expense, we are calculating it to verify whether so much of the interest which has been debited in the profit loss account actually exists or not, and whether it is right or not. So these are the substantive audit procedures. So why was it relevant to our discussion today? Because we have mentioned about the detection risk, and detection risk means that after the substantive audit procedures have been applied, there exists some material misstatement of class of transaction, account balances, and disclosure or aggregate of all. So that's why this was relevant today. We'll again come to the audit risk. So the audit risk is the risk that the auditor gives an inappropriate audit opinion on the financial statement that are materially misstated. I am intentionally repeating these definitions so that this gets cemented in your mind today itself. You don't need to learn it again and again. And what is the objective of an audit? The overall objective of an audit is to reduce the audit risk to an acceptable low level. Please understand it clearly, and I'll reiterate it. The objective of the audit is to reduce the audit risk to an acceptably low level. This may be achieved by performing procedures that respond to the assessed risk at financial statement, class of transaction, account balance, or assertion level. Financial statement, class of transaction, account balance, and assertion level. So at the macro level, at financial statement level, and at the micro level of assertion level. So number of embedded assertions are including in management representations about the financial statement. These relate to recognition, measurement, presentation, and disclosure. We'll read about that in detail. No need to worry about these terms. So audit risk is the risk. I'll come back to that. Audit risk is the risk of expressing an inappropriate audit opinion. Two key elements: inherent risk and control risk, and detection or engagement risk. And then the objective of the audit is to assess the risk of material misstatement and limit the detection risk. So first of all, we'll assess that what is the level of the risk that is there in inherent risk and control risk. And once we assess, we'll determine that how much we can trust the internal control system on the basis of our assessment of internal control risk. And then we'll see how much that we have to perform our substantive audit procedures to minimize the overall audit risk and minimize the detection risk. So here comes a case study. So Messrs. ABC and Company Chartered Accountants is hired to perform an audit of A Corp's financial statements. In previous audit, the firm has expressed concerns to management about the company's lack of internal controls around the payroll process. Going into this year's audit, the firm will assess the control risk as high for this particular area. So already the chartered accountants have assessed that the control risk is high for this particular area. Which particular area? Payroll process. AAPE's payroll system is also highly complex and it involves a large degree of manual input by the payroll clerk. So this should ring some bell. Then identify the audit risks. How will the auditors meet the audit objective? What should be the auditors consider while auditing the payroll process? So can anyone please identify the audit risk for me? Here, what they are saying is that AAPE's payroll system is highly complex and it involves a large degree of manual input by the payroll clerk. So I'm looking at your comments. Can anyone please identify the audit risk for me, whether it is inherent risk, control risk, or detection risk? Can anyone identify this for me? I'm looking at the comments. Yes, Sumit, you are right that this is an inherent risk because of the high involvement of manual input. And what we have seen is that we have already been given that there is high level of control risk that the auditors have already identified. And then there is high level of inherent risk because there is large number of manual input and the payroll system is highly complex. So, but of course, inherent risk is high and the control risk is high. So how should the auditor deal with this situation? How should the audit objective be met? The audit objective is, let's see what the audit objective we have discussed over here. The overall objective of audit is to reduce the audit risk to an acceptably low level. Since our objective is to reduce the audit risk to an acceptable low level, so we'll see that the overall audit risk is detection risk into inherent risk into control risk. We have already identified that the control risk is high, and we have seen that the inherent risk is high as well. So we'll have to reduce the detection risk. How will reduce the detection risk? We'll increase the sample size and perform more substantive audit procedures and increasing sample size in both in volume and amount. By increasing the amount of testing done around the payroll process, the auditors will effectively decrease the detection risk associated with these transactions. So you can see this chart of control risk and inherent risk. If the control risk is high and the inherent risk is high, then the overall risk of material misstatement, which is a function of inherent risk and control risk, is very high. That is the box 9. You can refer this, you can make this box in your exams as well if such questions comes, and this should fetch you good marks as well. So what are audit assertions? We have come to that in detail. So audit assertion means that the implicit or explicit claims and representations made by management responsible for preparation of financial statements regarding the appropriateness of various elements of financial statements and disclosures. Someone in the comment section had asked me that whether these are only financial or non-financial as well, the assertions. So the assertions can be non-financial claims as well. Yes, Ambika has asked me. So financials, so these can be non-financial claims as well as they are demonstrated in the disclosures also. So meaning of audit assertion again, implicit or explicit claims and representations made by the management. And these are elements of financial statements and disclosures. So example of audit assertion. For example, this example I've already quoted, if balance sheet of the entity shows building with carrying amount of $10 million, the auditor shall assume that the management has claimed that buildings are recognized in the balance sheet, actually exist at the period end. The entity owns or controls those buildings. It has the title document. It actually owns those buildings. The buildings are valued accurately in accordance with the measure and basis. And the building owned and controlled by the by the entity are including within the carrying amount of $10 million. So these are the claims by the management that is implicit and explicit when they write down that in their balance sheet. So audit assertions, there are three categories of audit assertions at the level of account balances, class of transaction, and presentation and disclosure. At the level of account balances, there are four implicit or explicit claims that it exists: completeness, rights and obligations, valuation. Classes of transaction: classification, accuracy, occurrence, cutoff, completeness. No need to worry about these. The meaning of these words. Will come to that in detail in the following slides. Occurrence, completeness, classification, understandability, accuracy, and valuation. In case of presentation and disclosure, we'll see their examples as well. So let's dive back. So first of all, we'll discuss about standard of auditing 315, and we'll see how it relates to the audit assertion. So standard of auditing 315, identifying and assessing the risk of material misstatement through understanding the entity and its environment, pretty short name, categorizes the types of assertion used by the auditor to consider the different types of potential misstatement. So first of all, remember that why do we use assertion? Please don't get lost in the universe of assertion without actually questioning why it exists and why are we studying that. We study these assertions just to understand the different types of potential of misstatements. So understand that and keep that in mind, that we are reading them to understand the different types of potential misstatements that can happen in financial statements. So these are very important. So assertions about classes of transaction, we've seen the classes of transaction. Occurrence, the transactions and events that have recorded have occurred and pertain to the entity. So it is quite obvious through the name only that it has occurred from the occurrence, but these also pertain to the entity. This has occurred to the auditee only and not to some other entity. That is the important point. That's why I've highlighted it. So example, salary and wage expenses has been incurred during the period in the respect of personnel employed by the entity. And salaries and wage expenses does not include the payroll cost of any unauthorized personnel. That claim is also being made by the company, which is an implicit claim that this salary expense is accurate and no unauthorized personnel have been charged over here. Second is completeness. All transactions and events that have been recorded, that have been done, have been recorded. So salaries and wages cost in respect of all personnel have been fully accounted for. Third is accuracy. Amount and other data relating to recorded transactions and events have been recorded appropriately. So salaries and wages costs have been calculated accurately. Any adjustment such as tax deduction at source has been collectively reconciled and accounted for. So it is accurate. Then cutoff transactions, very important concept. Cutoff transaction means that transactions of one period are recorded in that period only. Salaries and wages cost recognized during the period relates to the current accounting period. Any accrued and prepaid expense have been accounted for correctly in the financial statements. Then it is regarding classification. So transactions and events have been recorded in proper accounts. So for example, salaries and wage expenses can be divided into operating expense, general and administrative expense, and cost of personnel relating to any self-constructed asset which goes into CWI. So it has been correctly classified. So 5 items: occurrence, completeness, accuracy, cutoff, classification. Then we'll come about the assertions of account balances at period end. This is about the account balances that are shown in the balance sheet. Existence: assets, liabilities, and equity interest exist. So the assets, liabilities, and equity, that is the shareholding pattern, that is the shareholding that is shown over there in the balance sheet, they actually exist. We can verify that through the physical verification of assets are done to identify if the assets actually exist. Rights and obligations, that the entity holds rights and obligations to these of the items reflected over there. For example, we can verify that through checking the title documents and loan disbursal letters. Completeness: all assets, liabilities, and equity interest that should have been reflected in account balances are so reflected. For example, contingent liabilities that turned into real liabilities have been recognized so, and they are not being continued as contingent liabilities only. Valuation and allocation, you get it, that they are actually valued correctly. For example, valuation of intangible assets like patents, brand, etc. have been recorded as per the applicable accounting standards. Then assertions about presentation and disclosure. Occurrence and rights and obligations. Disclosed events, transactions, and other matters have been occurred and pertain to the entity. So these have actually occurred and these only pertain to the entity. So for example, transaction with related party disclosed in the notes of financial statements have occurred during the period and relate to the entity. Completeness, we know this, that all the disclosures that were necessary have actually been included in the financial statements. Classification and understandability. Financial information is appropriately presented and described, and disclosures are clearly expressed. There is no ambiguity in the disclosures. So this is the qualitative aspect as well, that it can be understood by a layman who is reading the financial statements. The nature of related party transaction balances and events have been clearly disclosed in the notes to financial statements. Users of financial statement, who are the users of financial statement? Government shareholders and investors and those charged with governance, all of them are the users of the financial statements, can clearly determine the financial statement affected by the related party transaction and balances and can easily ascertain their financial effect. Accuracy and valuation. Financial and other information are disclosed fairly and at appropriate amounts only. So these are the potential misstatements that could occur in the audit. And through these 4 types of audit assertion, this could occur, and this could be asked as a short note as well. That's why I've highlighted it over here. So on completeness aspect, it could be the potential misstatement that transactions are not identified at all. So the management might have missed some transactions either by error or actually with the malified intention. Source documents are not prepared. Source documents do not capture. Rejected source document not presented. Existence, fictitious or unauthorized transactions entered in source documents. So something that doesn't exist has been entered in the source document, and the total has been aggregated to more than that it actually is. Source documents overstated, similar example. Transaction duplicated on source documents. So for example, money received from a certain customer has been entered twice in their source documents. Then capture of source documents duplicated. Invalid source documents captured on subsidiary ledger. Recording. Source documents captured inaccurately. Processing of transaction is inaccurate. So inaccurate recording of the transactions in our books of accounts and inaccurate adjustment made in subsidiary ledgers. Cut-off procedures, transaction occur in one period are recorded in another period. So these are the potential misstatements that could occur, and this could be asked as a short note. So you should remember these audit assertions and their potential misstatements. So if there's any question, I can take that. Let me just go through the question through the question in your link. You may ask some questions if you have some query until here. So what we have covered until now is the risk of internal control audit assertions, and then audit risk of various types. Yes, Ambika has again asked that, is it the inherent risk which involves large degree of manual input? Yes, it's inherent risk. Is there any more question to that? Can you give mnemonic of all these 3 different types of audit assertions? No, Radha, I cannot give you mnemonic. You'll have to prepare it yourself. And so anyway, these are very logical steps, and you don't need any mnemonic for these audit assertions. Though I have prepared some summaries for easy remembering and revision of these notes. I'll get to that in the later slides as well. So we'll come to the 2 level of risk assessment. So what I have already told you is that we have to assess risk at 2 levels. One is at the financial statement level, and then at the specific assertion level. Remember it at the macro level at the financial statement level, and at micro level at specific assertion level. So at overall financial statement level, which refers to risk of material misstatement that relate pervasively to the financial statement as a whole and potentially affect many assertions. So this is regarding the risk of material misstatement that could occur to the entire financial statements. So for example, if you have identified or if it has been established that the management frauds in past have occurred. So this should lead the auditor to question the truthfulness of the entire financial statements, because you don't trust the management's intentions itself. So the entire financial statement comes into the question. So this is regarding the overall financial statement level uh, assessment of risk of material misstatement. Second is at the specific assertion level. That is our usual audit process that we have already discussed also. So, for example, specific assertions of at the class of transactions, account balance, or disclosure level, the three elements that we have discussed. This means for each account balance, for each class of transaction, and for each disclosure, an assessment of risk such as high, moderate, or low should be made for each individual assertion being addressed. The inclusion of fictitious receivables or inventory, this assertion is very closely related to the occurrence assertion of for transactions. So whether they have actually occurred or not, while we have included the fictitious receivables or inventory. So this is at the assertion level. I hope this is clear to you. So now we have a case study on audit assertion. Which of the following substantive audit procedures provides evidence over the completeness of non-current assets? So there are four things: completeness, existence, recording, cut-off procedure. We are discussing about the completeness. So which of the following substantive procedure provide evidence over the completeness of non-current assets? Select a sample of assets included in the non-current asset register and physically verify them at the client premises. So collect a sample of assets and physically verify. Review the repairs and maintenance expense account to identify any items of capital nature. Does it tell us about any completeness? For assets disposed of, agree the sale proceeds to supporting documentation and cash books. That is, check the asset disposed of with the amount in the supporting document and cash book, what we have received for that. And for a sample of non-current assets, recalculate the depreciation charge. So for this, you have to tell me that which of this is actually the substantive audit procedure that comments upon the completeness of non-current assets. So I'll give you one tip. In order to tackle these questions, candidates are encouraged to work through each procedure. See what is the objective of the auditor when they are testing for completeness, and consider whether the procedure above satisfy the objective. So you can share your answer in the comments. I'm looking at the comments right now. You have to identify the completeness. Does anyone have any answer on this? A, B, C, D, what should be the answer? So let's see. Let's deal with them one by one. Select the sample of assets including in the non-current asset register and physically verify them at the client premises. This confirms the existence but not the completeness, obviously, because through the physical verification we can only see that whether the assets actually exist, and we are taking a sample and we are not doing it on a complete basis. Review the repairs and maintenance expense account to identify any item of capital nature. Through this, we are actually looking at the completeness, because we are looking at the repair and maintenance account and seeing that whether anything that should have been capitalized have actually been capitalized or not. Therefore, this is the correct answer, because this shows the completeness of the. This goes to check the completeness of the non-current assets. Third, for asset disposed of, agree the sale proceeds to supporting document and cash book. This confirms the sale proceeds. It only, and this is only for the valuation or accuracy. And for sample of non-current asset, recalculate the depreciation charge. This is obviously non-relevant for us. Now, risk identification steps to identify the audit risk. So we'll come to the risk identification now, and we'll see what are the steps to identify the audit risk over here. What we can see is there are 9 audit risks, and we have prepared the pointers to remember the risk identification steps. So no need to get daunted by these long sentences. We have prepared a summary through which you can go through for revision or for learning purpose. Just remember to quote examples as well and point out the keywords over here that I've put in bold or highlighted. So first point is assess the significance of the assessed risk, impact of its occurrence, and revise the materiality accordingly for specific account balance. So for risk identification, the first step is assess the significance of the assessed risk. Significance, assess its significance, then see its impact on the occurrence and revise your materiality if you need to. For example, the auditor may assess the risk of non-disclosure of related party transactions. So you may go into an audit and you may assess that this company might not have disclosed all its related party transaction, which is a compulsory and material disclosure irrespective of the amount. So therefore, it will be identified as audit risk, and you'll have to revise your materiality and impact of its occurrence. Determine the likelihood for assessed risk to occur and its impact on our auditing procedure. So first was the identification itself, the risk identification itself. The second is the likelihood of its occurrence. You'll have to allot some probability to it, some percentage to it in your mind, and then document it in your audit documents as well. What is the likelihood of this risk? Likelihood of occurrence may depend on past experience with the entity, complexity, and assessed risk by the auditor. So it could depend upon the past experience, the nature of the management, whether the management is transparent or intransparent in nature, what are the complexity level of the transaction, and the assessed risk by the auditor. Document these assertions. You will have to document these assertions, whether these are at classes of transactions, account balances, and presentation of disclosure. What do these relate to? Then consider the impact of risk of each assertion. Then you'll have to identify whether this relates to the completeness, existence, accuracy, validity, valuation, and presentation. And then document that as well. Identify the degree of significant risk that would require separate attention and response by the auditor. Then you'll see that which response, so where you need to put your special attention to. And then you'll have to classify that in high, medium, low risk classification, and plan your response, plan your audit procedures accordingly. Then inquire and document the management's response. So you should also ask for the management response there and should not go by just your own assessment only. Identify what does the management actually think about those assertions, think about those risks, whether the management has already identified those risks and what is the management's overall view on that, and then document that management response. So we have discussed 6 steps over here. Assess the significance of assessed risk, then likelihood. Third is document the assertion. Fourth is document the completeness, existence, accuracy, validity, valuation, presentation. That is the risk on each assertion. Then identify the degree of significant risk and to which you will give your special attention. Planned audit procedures should directly address these risks. So this I've bolded especially that planned audit procedures should directly address these risks. So only identification is not enough. Your audit procedure should also show that you have actually performed your major audit portion over the high risk areas only. And inquire and document the management response. So these are the 6 steps over here. 7th is the nature of internal control that is in operation. After you've identified the risk and you've discussed with the management, you'll see what is the nature of internal control that the management has employed in the organization. For example, whether it is routine, whether it is designed or manual or automated. So if it is routine, then it should give you some level of comfort that it is done on daily or on some periodic basis. For example, daily bank reconciliation for stockbrokers or monthly bank reconciliation for other companies or fortnightly bank reconciliation as per the periodicity decided by the company. So whether it is routine or one of a thing like some kind of internal control that happens only once in 3 years, that should put you in some discomfort if you have identified it as a high risk item. Second, the design, whether it actually prevents, detects and corrects the errors on timely basis or not. For example, three-way matching of PO invoices and GRN. PO is purchase order, invoices in GRN, goods received notes. So we match these documents to see whether the order document, where the ordered quantity and ordered value has actually been received in the stores or not, and whether only that quantity and amount has been billed to us or anything additional has been charged to us. So this is the way of three-way matching of PO invoices and GRN. Manual or automated. So automatic funds control account prepared for various branches for efficient fund utilization. This could be there, or whether it is done on manual basis. Some accountant sits at the day end and identifies that which branch has how much of balance, and then he shifts the balances to the branches which lacks the funds. Whether this happens or there is some automated software that calculates this amount and automatically shifts the funds. So we'll have to see these control, the internal control in place through three perspectives: whether it is routine or one-off thing designed, whether it is properly designed, and whether it is manually or automatically operated. Then consider any unique characteristics of the risk. For example, a bank which incurred huge losses might impose cash withdrawal limit for indefinite period. This recently happened with Yes Bank also, that a bank which incurred huge losses might impose cash withdrawal limit for indefinite period. This could impose risk of cash availability for the companies which have accounts in that bank. So if your company, if your auditee had account in Yes Bank and it imposed limit of 1 lakh rupees per month only, then that would put your company in a dangerous position that they won't be able to utilize their cash that they had in their bank. So this is a unique characteristic of the risk which doesn't come off often, and that should be considered specially. And you should identify these unique characteristics of the risk as well, and you should not just pass by them without giving any notice to them. Then consider the existence of any particular characteristics which is inherent risk in the class of transaction, account balance, or disclosure that need to be addressed in designing further audit procedures. So it needs to be designing further audit procedures any particular characteristic. For example, high value inventory, complex contractual agreements, absence of paper trail on certain transaction streams, or large percentage of sales coming from a single customer. These could be some specific characteristics that should raise the stakes of audit risk, and then that should in turn compel you to address that in a detailed manner. So these are the 9 steps of risk identification. You have to remember them, and you can remember them through this summary, but remember to add examples and some keywords over there as well. So first is assess the significance of the assessed risk, impact of its occurrence, revise the materiality according to the specific account balance. Then determine the likelihood of the assessed risk, document the assertion, document the risk of each assertion, identify the degree of significant risk, and then planned audit procedure should directly address those risks. Management response, document that. Nature of the internal control, whether it is routine or one-off, designed well or not, manual or automated, any unique characteristics, and any particular characteristics. So these are the 9 pointers that you can remember. Then we come to the risk-based audit. So a traditional audit would focus upon the transactions which would make up financial statements such as balance sheet. A risk-based approach will seek to identify risks with the greatest potential impact. So this obviously makes sense that whichever area has the highest risk should be dealt with in more detail, and this is required in every type of audit. So I have raised a question over here: is risk-based audit a separate type of audit? No. Risk-based audit is an essential element of financial audit, both in the attest audit of the financial statements and the audit of financial statement transacted during evaluation of internal control. So you have to keep the risk-based audit approach in mind while conducting audit, and you can keep this figure in mind as well, that the more the probability of risk, the more its impact will be, and the more impact it should have in your audit procedures. So risk-based audit is an approach to audit that analyzes the audit risk, sets materiality thresholds based on the audit risk analysis, and develops audit programs that allocates a larger portion of audit resource to high risk areas. So this if you remember this sentence, this concept will be sorted, that larger portion of audit resources to high risk areas. So analyze the audit risk, set materiality threshold, develop audit program, and allocate a larger portion of audit resources to high risk areas. It focuses primarily on the identification and assessment of financial statement misstatement risk, and provides a framework to reduce the impact of the financial statement of these identified risks to an acceptable level. So this has always been our audit objective, to reduce the audit risk to an acceptable level, and this we do through the risk-based audit. So it provides a framework to the auditor to reduce the impact of the financial misstatements on the audit. So what is the objective of risk-based audit? To obtain reasonable assurance that no material misstatement caused by fraud or error exists in the financial statements. So I'll go through it again. The audit objective of risk-based audit is that obtain reasonable assurance that no material misstatement, whether caused by fraud or error, exists in the financial statements. Audit risks are brought by error or fraud. We'll understand their difference because it is quite important for you to understand the difference between error and fraud. Error is an unintentional mistake resulting from either omission or commission. Omission means that you have forgotten to include it, and commission means that you have done something wrong. As when legitimate transaction and or balances are excluded from the financial statements, or by commission, as when erroneous transaction or balances are included in financial statements. For example, posting payment entry of ABC and Company to ABC Private Limited. An error risk may arise from an error in principle, estimate, critical information processing, financial reporting process, or disclosure. So, for example, error in application of WDV method, error in estimating provision of doubtful debts, posting errors, etc. So, error may rise from an error in principle, estimate, critical information processing, financial reporting process, or disclosure. Fraud is an intentional misstatement in accounting records or supporting documents from which the financial statements are prepared. It is intended to deceive. So this is very important, that the intention is the deception over here. It is intended to deceive financial statement users or conceal misappropriation. For example, store manager overstating inventory to underreport inventory damages. Fraud risk involves manipulation, falsification of account record, misrepresentation of payment transactions, or misapplication of accounting principles or misappropriation. For example, using accounting methods to show high profit ratio, misrepresenting a known liability as contingent liability, hiding doubts on going concern principle, misappropriating investors or bankers' fund. You remember this example? If you can remember this example, you will be able to remember the fraud risk by itself. Then why fraud and error distinction is relevant to us. The auditor has the responsibility to plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement, whether caused by fraud or error. So you would be required to state whether this was because of error or fraud, and if you are not required to state, then you will be expected to understand whether this was by error or whether it raises your suspicion of fraud, because if there were fraud or if there were error, you will have to amend your audit procedures accordingly. And your statutory responsibility also changes, that you may study in your other chapters of the audit. So steps to conduct risk-based audit. There are 3 steps to conduct risk-based audit. First is risk assessment, the second is risk response, and the third is reporting. First is risk assessment, second is risk response, third is reporting. We'll come to risk assessment. So perform client acceptance or continuous procedure. So that is accepting the audit. Whether you perform the client acceptance, that is whether it's the first time, or continuous procedure, or you're continuing. Planning the overall engagement, which is audit planning, which you would have already known. Third is performing risk assessment procedure to understand the business and identify inherent and control risk. You have to identify inherent and control risk by performing risk assessment procedure, like we identified in the case studies that we have discussed. Then identify relevant internal control procedures and assessing their design and implementation. So after assessing the risk procedure, you identify the various relevant internal control procedures and what is their design, how are they being implemented, whether there is any faulty design, whether there is any lack in the design, and if the design is okay, whether they are being implemented properly, and if they are not being implemented, then you should identify the risk of material misstatement accordingly. Those controls that would prevent material misstatement from occurring or detect incorrect misstatements after they have occurred. Assessing the risk of material misstatement in financial statement, identifying the significant risks that require special audit consideration, and those risks for which substantive procedures alone are not sufficient. Communicating any material weakness in design and implementation, and making an informed assessment of the risk of material misstatement at financial statement level and at assertion level. So we have discussed these things separately in our previous discussion also, and we'll continue to discuss these things repetitively, but we'll have to see that steps to conduct risk-based audit need to be put in this sequence only. So we'll need to remember this. For examination purpose, you'll need to remember these steps, and you'll need to put in there in this sequence only. Then first was the risk assessment. First step was the risk assessment to conduct risk-based audit. Second is risk response. Risk response is this phase of the audit is to design and perform further audit procedure. How would you respond to the risk that you have already assessed in the first step, and how will you correct the evidence for the same? So design further audit procedure, activity, and perform further audit procedure. This is what we have to do. First of all, we have to design a further audit procedure, and then we have to actually perform them. What is the purpose of these activities? Develop an appropriate risk response to assess risk and reduce the audit risk to an acceptably low level, which is our audit objective. And what we need to document, update the overall strategy. You'll have to update your overall strategy from the audit planning phase that you did at the first time. Detailed audit plan that links to assess risk to further audit procedure. You have to identify the further audit procedure that you will do. And work performed, audit findings, staff supervision, working paper. This is the documentation thing. So do you need to prepare this flowchart in the examination? Yes, you need to prepare this flowchart if you want to get good marks. Do prepare this flowchart. So steps to conduct risk-based audit. First step, we have discussed risk assessment. This is the second step in detail, which is risk response. So as risk response in planning, the audit procedure include assertions that cannot be addressed by substantive audit procedure alone. This can occur where there is highly automated processing of transactions with little or no manual intervention. No matter how many substantive audit procedures you apply, you'll get the same result. So it doesn't make much sense to apply those substantive audit procedures in detail on number of transactions which are automated and which are supposed to give the same output for the same similar input. So second is existence of internal control, that is, if tested, could reduce the need or scope for other substantive audit procedure. Whether the internal control exists and on what processes does the internal control exist, and how effective its design and implementation is. For example, system-based compulsory approval of payments as per payment approval matrix. So if the system-based payment approval matrix is there, excuse me, payment approval matrix means that the amount is decided for which authorization is required, whose authorization is required. It is already configured in the system and it flows automatically to their emails or to their dashboard. So if it is system based, you can skip the substantive audit procedures over there, and you can reduce the scope of substantive audit procedure over there by minimizing the number of transactions that you can see, because since it is system based, so there is no need for extensive look into that. You can just see whether the system is operating fine or not. The potential for substantive analytical procedure that would reduce the need scope for other types of procedure. For example, after getting top 80% debtor balance confirmation, your focus can be shifted to the other accounts. Then the need to incorporate an element of unpredictability. You should incorporate this element of unpredictability, and you should identify whether it is actually needed or not according to your risk assessment. For example, surprise inventory check, surprise cash verification. This could actually reveal the inefficiencies in cash accounting and inventory accounting. And then, or you could actually make a surprise visit to the production line also, and you can see how actually it is being, the products are being produced, how in the manufacturing unit the products are being produced, how are they being stored, what is the quality check mechanism, are there any quality people actually standing there doing the quality check on concurrent basis, or whatever the procedures are. The need to perform further audit procedure to address the potential for management override of controls or other fraud scenarios. So management, which actually makes the internal control, management and those charged with governance are actually responsible for creating the internal controls. Sometimes they might override the controls, and they might say that this is just for the junior people and we can override the controls, or they might have that intention. Or there could be some fraudulent scenario as well. So you need to identify those scenario, and if you have identified those scenarios, then you need to perform further audit procedure to dispel either your doubt or to confirm your doubt. So for example, identification of frauds through collision. So two or more people who are actually required to authorize a certain payment collide, and they make payment to their own personal accounts or to the related party. So this could be done through collision as well. So the need to perform a specific procedure to address significant risks that have been identified. For example, if during audit sales seem overbooked vis-a-vis cash receipts and debtor balance, further audit procedure may be performed. This is but obvious thing. So at a response level, when planning audit procedures, include these elements. So these 6 elements need to be included. Assertion that cannot be addressed by substantive audit procedure alone, highly automatic transaction, existence of internal control, reduce the need scope for other substantive procedures, potential for substantive analytical procedures, the need to incorporate unpredictability, address the potential of management override of control, and significant risks that have been identified. So we have covered 2 steps over here, steps to conduct risk-based audit. Risk assessment, risk response. Third is reporting. So once we have assessed the risk, and once we have performed our substantive analytical procedure and other procedures that we have seen in the risk response, then we'll go to the reporting. How do we need to report this? So here we have flowchart activity, evaluate the audit evidence obtained in this. In the second step, evaluate what are the audit evidence obtained. Is any additional work required? If yes, then go back to the risk assessment and perform that additional work. If no, then prepare the auditor report. What is the purpose of evaluating the audit evidence obtained? That determine what additional work is required, if any it is required at all. And what is the purpose of auditor report? That is the entire purpose of the audit, actually. So form an opinion based on audit finding, and submit that audit report to the auditee, and make significant decisions basis that, and sign the audit report and keep that in your documentation. Then other than that, what is the documentation requirement? Additional risk factors that you have identified, revised audit procedures, changes in materiality, conclusions reached. So these are quite obvious steps if you actually look at them intently, and these are quite obvious steps. No need to remember them extensively, because once you go through these slides or through your study material 3 or 4 times, this will anyway get etched in your mind. This is, if you have conducted audits during your internship, this should be seeming like a cakewalk to you. The reporting is, then we come to the reporting phase. The final phase of the audit is to assess the audit evidence obtained and determine whether it is sufficient and appropriate to reduce the risk of material misstatement. Sufficient and appropriate, you must be coming across it all the time in the auditing subject. So to assess the audit evidence obtained and determine whether it is sufficient and appropriate to reduce the risk of material misstatement to an acceptably low level, which is our audit objective, to bring the audit risk to an acceptably low level. It is important at this stage to determine change in assessed risk level, conclusions, and appropriate whether the work performed are appropriate if suspicious circumstances have been encountered. Any additional risk should be appropriately assessed, and further audit procedures should be performed as required. When all procedures have been performed and conclusions reached, audit findings should be reported to management and those charged with governance. To management and those charged with governance, you have to report your audit findings and audit opinions and a decision made on the appropriate wording of the auditor report. So you have to report that. So we have covered these topics, quite a few topics over here. So if any one of you has any doubt over here, I can take that before I move on to the next topic, which is internal control, and which is again a very detailed concept. So, does any one of you have any doubt over here? I'm checking the link now. You may post your doubts. Inherent risk means the risk that is inbuilt over there, that exists because of the nature of financial statements. So there could be a highly complex transaction that a company would be occurring, or there could be a high intervention of human decisions. So that could result in some extra risk, extra layer of risk in the overall audit risk, which is called the inherent risk. No, it cannot be avoided. Inherent risk cannot be avoided. Yes. So we can move on to the next topic now, which is the internal control system, nature, scope, objective, and structure. So again, this is a very important topic. So I'll start with asking a question that statutory audit is a one-off activity, and in big companies it happens concurrently, but it is more so relates to the statutory compliances and the statutory reporting that is required out of the auditor to report on and to give an opinion on the truthfulness and fairness of the transactions. But that is only on a very limited basis. But what do companies do all year, the entire year, to ensure that the business processes are actually functioning efficiently with and effectively, with least cost wastages, no frauds are happening, and the overall objectives of an organization are met? So what do companies do all year to ensure all of these activities? They employ internal control system. An example of simple internal control could be, before making a payment of more than 5 lakhs, the approval of senior manager shall be taken. This is an example of payment approval matrix that I just quoted about. So this is the internal control mechanism that the company employs. It's a simple internal control mechanism. Second could be sophisticated ERP-based internal control, automatic three-way matching of purchase order, goods or service receipts, notes, and invoices to ensure no overpayment is being done and materials are actually received, material or services are actually received. Then example of failure of internal control could be manual purchase by passing the automatic system and paying for more than what is received for the over-invoiced goods. So if you override the internal control system, there are more chances of some failure of the intent of internal control. So these are anyway reduced in the activities of the organization, and this is what the auditors also look into, whether there are any exceptions to the internal controls and what are the approval matrix of those exceptions as well. So these are the examples of some internal control. So we'll go to SA 315, which defines the internal control system. And you have to remember this definition. This is very important. Through this definition only our remaining discussion flows. So SA 315 defines the system of internal control as the process designed, implemented, and maintained by those charged with governance, management, and other personnel. So please remember whose responsibility it is to design, implement, and maintain the internal control system, not the auditors. It is not the auditor's responsibility to maintain the internal control system, to implement the internal control system, or even to design the internal control system. The primary responsibility of it is on those charged with governance, on management, and other personnel who the management or those charged with governance have actually delegated that function, to provide reasonable assurance about the achievement of entities' objectives. Reasonable assurance, not the absolute assurance. No internal control system can provide you the absolute assurance that no frauds or errors will ever occur in the organization. No internal control system or audit can provide you that. Only a reasonable assurance can be provided. And for what? For the achievement of entities' objectives. So this is specifically for the entities' objectives. And with regard to reliability of financial reporting, the financial reporting can be relied upon by the users of financial statements. Effectiveness and efficiency of operations, the work are actually getting done, and they are getting done with the minimum resources that is being required for those effectiveness. Safeguarding of assets are actually safeguarded in compliance with applicable laws and regulations. So these four items actually form the four scope items of our internal control system, and this scope of internal control system flows from this essay only. So I'll go through that again. Defines essay 315 defines the system of internal control as a process designed, implemented, and maintained by those charged with governance, management, and other personnel to provide reasonable assurance about the achievement of entity's objective with regard to reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets, compliance with laws and regulations. And risk assessment as per 315, the auditor should identify and assess the risk of material misstatement. At the financial statement and assertion level, they were providing basis for designing and implementing responses. We have discussed these in detail. So is every check and balance in the organization a part of internal control? What are its main objectives? Where does it start and end? Is only accounting control enough? These are some questions that should rise in your mind. So first of all, is every check and balance of the organization a part of internal control system? No, internal control is a process effected by people that supports the organization in several ways, enabling it to provide reasonable assurance regarding risk and to assist in the achievement of objectives. So please understand only those controls which assist in the achievement of organization objectives. That has been written in the SA 315 also. Only those are the internal control system. Therefore, internal controls include all the admin controls concerned with decision making, process leading to management authorization of transactions. Such controls include production method, time and motion study, etc., etc. No need to remember this list. This is just for the reference purpose. If so many controls are internal controls, what should the auditor audit? Should the auditor audit each and every internal control system? No. Policies and procedures having a bearing on the assertions underlying the financial statement. So this is very important concept. Do auditors need to audit each and every internal control that assists the achievement of objectives? No. The auditors are expected to study the policies and procedures and assess the risk on the internal controls that have a bearing on the assertions underlying the financial statement. That's why we read all about the assertion in detail. And so only those are to be studied which have bearing on the assertions underlying the financial statement. The more the impact on financial statements, the more importance does the internal control gain. Ask the question if it is integral to the activities of the organization and whether it assists in the achievement of objectives. For example, controls on small garden maintenance of a common facility of a manufacturing unit may not be a part of internal control, and it might not lead to the achievement of objectives, and it might not be related to the assertions underlying the financial statement. So no need to worry about the length of grass, though there could be some controls related to that. So what is the scope of internal control? We have already seen these controls, and where we have seen these controls, the scope in the SA 315 only. That's why I'm saying that you should remember this highlighted area at least, that the reliability of financial reporting, effectiveness and efficiency of operations, safeguarding of assets and compliance. So these are the four scope items of internal control. Facilitates the effectiveness and efficiency of operations, help ensure the reliability of internal and external financial reporting, assist compliance with laws and regulations, and help safeguarding the assets of the entity. So this is what internal control should at least do. So, and this serves as the internal scope of internal control. So now we come to the limitations of internal control, and we see why they do not provide the absolute assurance to the auditors and the management, and why the audit is even required. So do internal controls guarantee elimination of fraud and errors and total cost effectiveness? Of course not. There are certain limitations of internal controls. You need to remember this, but these are very easy, so you won't need to remember them word to word. You can just understand these concepts, go through them a couple of times, and these will be etched in your mind. So first is the cost benefit. Some internal controls are quite costly in relation to the benefit that they might bring in the later stage. So if the cost is higher to the benefit, then there is no need uh, for that internal control, and management may dispense away with the implementation of that internal control. That could give a scope to the errors and frauds to occur because of the lack of that internal control. So management's consideration that the cost of an internal control exceeds the expected benefits to be derived. This is one of the limitations of internal control. Second is outliers and human errors. So for example, transaction of unusual nature, the potential of human errors such as due to carelessness, distraction, mistakes of judgments, and misunderstanding of instruction. For example, wrong party debited, wrong tax applied leading to penalties. These these transactions, these human errors are there in the ERP systems as well, because there are also some level of manual interference is required while making and posting entries. And if that manual intervention is there, then there is cause scope of some human error. Then collusion, the possibility of circumvention of internal controls, that is bypassing the internal controls through collusion with employees or with parties outside the entity. So two or more people can collide, and they may circumvent an internal control. For example, collusion of payment authorizer and payment maker to make payment to a related party's account. Then abuse by the process owner. So the person who is supposed to implement, who is supposed to oversee the maintenance of internal control, is actually abusing the internal control itself. So the possibility that a person responsible for exercising an internal control could abuse that responsibility. For example, those charged with governance themselves overriding the internal control. So you cannot do anything about it. And this is one of the limitations of internal control. So these are the four limitations of internal control that you need to remember. First is the cost benefit. Second is the outliers and human errors. Third is the collusion. Fourth is the abuse by process owners. So we have studied what are the internal control system, what is the internal control, defines the system of internal control as a process designed, implemented, and maintained by those charged with governance, management of the personnel to provide reasonable assurance of about the achievement of entities' objectives with regard to these four scope items. Then we have studied about the limitations of internal control. What are those? Cost benefit, outliers and human errors, collusion, abuse by the process owners. Now we come to the structure of internal controls. This is quite interesting topic, and you should understand them in quite detail, because this will be very, very helpful in your practical audits as well, and during your time as a chartered accountant. This will be of very much help, and we have certain case studies also here which are quite interesting. So we'll start with the structure of internal control. So there are 5 levels of internal control. First is transaction authorization. Second is records and documents adequacy. Third is segregation of duties. Fourth is accountability and safeguarding of assets. Fifth is independent checks. So transaction authorization, you can get it through name only. Records and document adequacy, again, you can understand. Segregation of duties must be new to you. And then accountability and safeguarding of assets, you must have read about it. Independent checks is again unknown, a familiar topic. Then we'll dive to segregation of duties, which is a relatively new topic for us. So segregation of duties, please understand this concept clearly, because this is going to be very helpful to you. Also, this is the reason behind most of the frauds that you come across on the news channels as well. So segregation of duty. So there is one principle of segregation of duty. If you can remember this one line, you will understand the segregation of duties completely, which is no one person can carry through the completion of transaction from start to finish. No one person can carry through the completion of transaction from start to finish. This is the principle of segregation of duty. And why is there? Why it is so? To minimize the occurrence of frauds and errors and to detect them on timely basis when they take place. So first of all, we have to minimize the occurrence. We cannot eliminate them, so we have to minimize them. And then to detect them on timely basis when they take place. How? By segregating four functions. You have to segregate four functions in order to achieve a proper segregation of duties and to comply with the segregation of duty principle. And wherever it is not, wherever the segregation of duty is in non-compliance, you are required, you as an auditor are required to point this out specifically. Even if no fraud or error has happened, you are required to report these the breach of segregation of duty principle. This is that important. So what are those four functions that need to be segregated? Authorization, execution, custody, record maintenance. Please remember them: authorization of transactions, execution of transactions, physical custody of related assets, and maintenance of records and documents. This question could be asked from you in interviews as well, in exams, of course, that what are the four functions that need to be segregated in the segregation of duty principles. And then you have to answer this: authorization of transaction, execution of transaction. Who is authorizing the transaction and who is executing the transaction must not be the same person. Then who is keeping the physical custody of the related assets and who is maintaining records and documents of those assets or those transactions. These four people should be different. These four functions should be allocated to four different people. Consider cost and efficacy. Cumbersome procedure, over elaboration of records, unduly high cost. These should be avoided. And then periodic job rotation should be there to avoid undetected fraud and error by a person. For example, cash embezzlement, avoidance of vested interest by staying long in a position. For example, procurement. In procurement function, if the procurement manager and the supplier develop a friendly relationship, then there could be some over invoicing by the supplier, or there could be delivery of under quality goods as well. Then therefore the periodic job rotation is required. This is just an example. So to avoid undetected fraud and error by a person, avoidance of vested interest by staying long in a position, up-to-date work, and careful because of review. Because, for example, year-end inventory count by different department personnel. This I've witnessed myself as well, that at the end of the year, the inventory count is done by different department personnel and not just by the inventory keepers. So, and that actually makes them more careful because they are subjected to review by the other departments as well. So this is the fundamental principle of periodic job rotation that you should remember. There are examples of frauds without proper segregation of duties. So personal purchases, an employee can divert funds to buy goods or services on his own behalf. This is usually done by approving his own expense reports or supplier invoices. So if the person who is authorizing the transaction and executing the transaction himself, he can actually divert funds to buy goods or services on his own behalf. Fund diversion, not recording the sale of customer invoice in the accounting system to hide diversion of customer payment. This could be because of the absence of segregation of duties. Proper segregation of duties would prevent a single person from processing the customer invoice, receiving, entering, and disposing the payment, applying credits, and performing bank reconciliation. This might sound little theoretical to you, but believe me, this happens all the time in all the organization where there is absence of segregation of duties. We'll come to the questions now. So the first question is, Navjeevan Hospital is a multi-speciality hospital which has been facing a lot of pilferage and troubles regarding their inventory maintenance and control. On investigation into the matter, it was found that the person in charge of inventory inflow, the one who is in charge of inventory inflow and outflow from the storehouse, is also responsible for purchases and maintaining inventory records. Okay. According to you, which basis of system control has been violated? Also list down the other general conditions pertaining to such system which needs to be maintained and checked. So you may write down your answer. I'm waiting for your answer in the comment section. The person in charge of inventory inflow and outflow from the storehouse is responsible for purchases and maintaining inventory records. So in segregation of duty, which of the element is being compromised here? Which two or three responsibilities are being done by the single person? I'm waiting for the answer. Which two or more activities are being done by the single person, which is required to be segregated in the segregation of duty principle? So, purchase, execution, and record maintenance lies with the one person. So, therefore, this segregation of duty is being compromised over here. And when the to 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 answer this question, you should write the brief summary of the segregation of uh, duty principle over here that we have discussed. Consider cost and efficacy, periodic job rotation. You write all that, and after that, you answer this question that this has been violated over here. Purchase, execution, the one who is executing, and then one who is record maintaining. That is the second and the fourth are being done by the same person. That's why this fraud is occurring over here. Similarly, we have a second case study also here that you can go through on your own. Then we come to the structure of internal control. The structure of internal control. Uh, Before we proceed to the structure, I'll take 5 minutes of break, and after 5 minutes, I'll get back to the structure of internal control. And we'll start with the question. So if you have any question, you may post it over there. You may comment it down, and we'll begin with the questions only after this 5 minutes break. So I've got a few questions over here. Yes, Ambika has answered it right. That segregation of duty purchase is being done by the separate of other than the inventory personnel. Maker and checker concept is violated. Sumit, you will not answer like this that maker and checker concept is violated, though your answer is though your logic is correct that maker and checker concept is violated. But for that, you'll have to answer through the segregation of duty only and through the segregation of duty principle only. Your understanding is correct, but you need to word it in this way that the execution and maintenance is being done by the same person, which is which are two of the four elements of segregation of duty that needs to be segregated. Then Kirthana is asking, sir, how to approach case study question towards internal control in exams. So, Kirthana, first of all, you should write down the principle of the internal control that is regarding which the question has been asked. Write down the standard on auditing 315 if it is applicable over there, and then answer the then write down the case scenario that is mentioned over there, that this is what has been provided to us. And if you are making any assumption over there, write down your assumption as well and underline your assumption. After that, answer your after that, give the answer to that query. So I hope that makes it clear. If there is any more query on that, you may write it down in the comment section. So we'll move on to the objective of we'll move on to the structure of internal control. So authorization and transactions. We'll come to the authorization of transaction. We have done with the segregation of duties in the structure of internal control. Now we'll come to the authorization of transactions. So authorization of transaction has two elements: delegation of authorization. So as a company is an artificial entity, as you know, and it has to delegate the responsibilities and authorities to different people, because through people a company's work is being done. So delegation of authorization to different levels and to particular persons are established by management for executing transactions. Examples: expense authority matrix authorizing senior managers across the company to spend up to USD 5K on business travels without any prior approval. Mandatory approval of deputy CFO for entering deals with more than 5% margin or less than 5% margin, whatever that authority matrix says. Procedures to provide assurance that authorizations are within the scope and on the terms of authorization should be established. How independent comparison of transaction documents with the defined authorization should be done. So, first element is the delegation of authority. Second is the procedure to provide insurance. So, we have done with the segregation of duties. We are done with the transaction authorization. Now we'll come to adequacy of records and documents. So, ensure assets recording and custody. First of all, you should ensure assets recording, that whether they are being recorded, and custody. Facilitates accountability. For example, laptops, broadband distributed to employees working from remote locations. So who has the custody of those documents and whether they are being properly recorded or not. Assets and record protected from unauthorized access, use, and disposition. Please note these terms, that you have to use these three terms in case a question comes in regarding this adequacy of records and documents. Access, use, and disposition. Disposition means who has the control or who has been assigned that asset. So assets and records should be protected from unauthorized access, unauthorized use, and unauthorized control or assignment. Third is records with sufficient description to facilitate identification. For example, some of the assets have barcodes, some has serial numbering, etc. Its location, so that assets can be physically verified periodically. So there should be an asset register, and that asset register should have sufficient description as to facilitate identification. Second element is include authorization documents executed in accordance with management's authorization. Authorization document means letter of authority that this asset can be assigned to this particular resource or not. Or there should be some policy regarding that. Meeting accounting aspects. promptly recorded with correct amount. It is promptly recorded, that is, it is not delayed, and then recorded with the correct amount. Appropriate account and period obviously facilitates preparation of financial statements in accounting in accordance with AS accounting principles, etc. So meet accounting aspects, includes authorization documents, and ensure assets recording and custody. Now we have covered three elements of this: transaction authorization, records and documents adequacy, segregation of duties. Now we are left with two: accountability and safeguarding of assets, and independent checks. Accountability and safeguarding of assets. First is asset life cycle. Process should cover all stages from acquisition of the assets, its use until its disposal. So it should cover its entire asset life cycle. Periodic physical verification and reconciliation with records. Frequency, consider nature, value, susceptibility to error or fraud. So according to these factors, you may decide upon the frequency. For example, investment documents are checked every quarter on every quarter basis for big organizations, because there is quarterly review, quarterly financial statements are released for the limited companies. So for that, quarterly investment documents are checked and verified. Authorization: only authorized personnel should have access, including physical access, control over use and disposable authorization documents. This we have already discussed. Avoiding information security risk by restricting access, avoiding fraudulent scrap sale by invoking asset disposal authorization matrix. Proper records, we have discussed this. Independent checks, this is the last element of the structure of internal control. To assess whether all the above discussed and other controls are actually working, independent checks are performed. Independent checks are performed to assess the control effectiveness of design and implementation. So please remember these terms as well that we have highlighted over here: design as well as implementation. Example: design flaws. If only one person is authorized payment, maker, checker in inventory controls. Implementation flaws: not attaching authorization document in ERP as opposed to the authorization policy. So there could be a design gap or there could be the implementation gap. Objectives of internal control of accounting system. Since accounting is more closer to the auditing profession, and we are more so focused upon the assertions that are made in the financial statements, and more of that are most of them are of the nature of accounting only. So we are discussing here the objectives of internal control of accounting system and not the internal control of other systems. So these are the four objectives of internal control accounting system objectives. First is the transactions are executed through general or specific management authorization. All transactions are promptly recorded in an appropriate manner to permit the preparation of financial information and to maintain accountability of assets. Third is assets and records are safeguarded from unauthorized excess, use, or disposition. Assets are verified at reasonable intervals and appropriate action is taken with regard to the discrepancies. So appropriate action is taken with regard to the discrepancies. Please underline this. Second thing is, you might be noticing that we are repeating the concepts over here. We are repeating the concepts in this chapter. These are being repeated with a specific intention that these are that important. These are very important and these are required to be remembered by you, to be understood by you so clearly that you should be able to talk about them while sleeping also. As auditor, you will be expected to have the conceptual clarity of all of these aspects. That's why they are being repeated over here. So objectives of internal control of accounting system. What are the objectives of internal control system? Determined by the management after considering the nature of business, scale operations, the extent of professionalism of the management, etc. The basic accounting control objectives that are sought to be any accounting control system. So any accounting control system, be it automatic, be it manual, or be it in a small organization, be it in a big organization, or in an NGO, any accounting control system. 7 aspects are required to be met by any basic accounting control. First is it has to be recorded. The transactions need to be recorded, transactions need to be real, properly valued, recorded, timely, that is cut-off procedure, properly posted, no incorrect posting, properly classified and disclosed, and properly summarized, that is balance sheet and disclosure. So these are the 7 essential elements of the basic control objectives, basic accounting control objectives. Do you need to remember all these 7 objectives? Yes, you need to remember all of them. So now we have a case study. The auditor inquired on the periodicity of physical verification. So this is a case study on the internal control. The auditor inquired on the periodicity of physical verification and sales process in a warehouse. So there is a warehouse, and he's inquiring about the process of physical verification of the stores and sales process through that warehouse. The management gave the following response to the auditor. First, the physical verification takes place every 6 months, okay, and the warehouse keeper is responsible for physical verification. The warehouse keeper himself is responsible for the physical verification and sending records back to the head office. Okay, because of low operations in past year, the warehouse keeper himself takes care of invoicing and dispatching the goods. Monthly invoice details along with the monthly stock register is sent to the head office. This year, there is substantial difference, obviously, among inventory as per the books and inventory as per stock register and inventory as per physical verification in descending order. So that means the inventory as per books is the highest, inventory as per stock register, which is in the warehouse, has lower amount, and inventory as per physical verification turns out to be the lowest. After the visit, the auditor concluded that the warehouse keeper was issuing the stocks with invoices. However, on the sales return, the credit notes were issued to various customers and the entry was made in the stock register. But physically, the goods were never returned. Okay, so there is a fraud. What kind of audit risk was it? Inherent risk and control risk, because these instances are inherent to the nature of business and design gap or ineffectiveness of internal control system. Control risk and detection risk, because of the fault in design and implementation of internal control system and identification issue. Risk of fraud, because the fraud seems to have occurred in the warehouse. Risk of error, because there was error in the presentation in the financial statement last year. So what risk was that? Control risk and detection risk, inherent risk and control risk, risk of fraud or risk of error. Assign them A, B, C, D. Please answer in the comment section. I'm waiting for the answer. No, there's no risk of fraud. See, we have already seen the types of audit risk. There is no such risk of fraud in what we have discussed. There are only 3 types of risk: detection risk, control risk, and inherent risk. So there is no risk of fraud over here. What actually exists over here is the risk, control risk, and detection risk. So control risk, because the internal control is lacking over here. It is a faulty internal control system where you are giving these so many responsibilities to a single person. Detection risk, because this says that there was some error in the last financial statement as well. So this is control risk and detection risk. Then we come to the second question: how can auditor minimize the audit risk? The auditor does not have any control over the control risk. The auditor does not have any control over the inherent risk. The auditor does not have control over any risk of material misstatement, because risk of material misstatement is the function of inherent risk and control risk. He can only minimize the detection risk. So the auditor can minimize the audit risk by minimizing the detection risk. This I have answered for you. You have to answer the next question. Which internal control component seems to have been compromised as the root cause here? Lack in safeguarding the assets of the company, lacks in compliance control leading to non-compliance of sharing inventory level with GST department, segregation of duty, inadequate controls, inadequate records and document leading to non-recording of correct inventory value. Which control component seems to have been compromised here? Please answer. Please answer over here. Which internal control component seems to have been compromised over here? Yes, it is segregation of duty. Which segregation of duty aspect seems to have been compromised here? Authorization, execution, and record keeping. Authorization, execution, and custodian. Execution, custodian, and record keeping. Custodian, record keeping, and authorization. So we'll see it again. The warehouse keeper is responsible for physical verification and sending records back to the head office, and he also issues the invoices. Please answer which one of them is being compromised over here. Yes, Sujanya, it's C, execution, custody, and record keeping. Because he is also executing the invoices, he's the custodian over here because he's a storekeeper, and then he's maintaining the records as well. So these three duties are being done by a single person when only one of them is to be allocated to only one person. Now we'll come to the components of internal control. There are 5 components to internal control. The first is control environment. The second is entity's risk assessment process. Third is control activities. Fourth is information system and communication. Fifth is monitoring of controls. Excuse me. So these are the 5 components of internal control. First is control environment. So components of control environment. Communication and enforcement of integrity and ethical values. So in the control environment, we have these various seven elements over here, and in this, the first of the element of the control environment is communication and enforcement of integrity and ethical values. The effectiveness of control cannot rise above the integrity and ethical values of people who create, administer, and monitor them. So as we have seen in the limitations of internal control as well, that those people who are actually developing, maintaining, and developing, controlling, and maintaining these internal control system, if they override, then it is obvious that the lower level of employees will also override that. And so it has been very articulately put over here that eloquently put over here that integrity and ethical values of the people who create, administer, and monitor the effectiveness of controls cannot rise above that. So if those charged with governance and management are only overriding that, so that the same thing can be expected from the people at the lower strata of the management. So how does management deal with the identified instances? So for example, if the management identifies that someone has compromised over the integrity and ethical values in the company, how do they actually deal with that? Do they make a stricter punishment for that, or do they let it go? That sends a message over the entire company, and that actually impacts upon the overall control environment. So this is that important. That's why we are discussing about the control environment. You cannot just write down the laws, write down the internal control system and expect everyone to follow them. You have to create a control environment for its proper functioning. And in control environment, these are the elements to that. And then what is the environment the management has created and the standards and organization and its employees follow? What is the environment that the management has created? How does it sensitize the employees of the repercussions of following such practices? So if you ever had been to some good organizations, to some listed organization, or to some IT organization where you might have done some audits, they regularly send emails of data breaches instances. They regularly send the best practices of data privacy, etc. That needs to be followed by each and every of the employees. Even the senior employees are let go because because they compromise with the data of the organization, knowingly or unknowingly. Even unknowingly, they are very strict with the data, the IT companies, etc. And so, how does it sensitize the employees of the repercussions of following such practices? So, this is also one way of sensitization through sending them regular emails, through boardings, through boards, through hoardings, etc. What are the behavioral standards communicated to the employees explicitly and implicitly? Again, we have come across this term. Example: does management expel and take legal actions against the employees involved in frauds, or tolerate them, or at worst, hand gloves with them? That is, override the control. Commitment to competence. So the first element was the communication and enforcement of integrity and ethical values. Second is commitment to competence. Incompetence breeds errors. This is of course thing, and competence is the knowledge and skills necessary to accomplish tasks that define the individual. Whether the people actually have those skills and knowledge, and if they do not have those skills and knowledge, internal control system will definitely fail. They would not know what to do with those internal controls. They would not know what to do with the processes that they've been assigned with. So, for example, does management hire, retain, and promote skilled and competent employees or unskilled, obedient? Then also job description shows commitment to competence. So the job description should not be like this, that where it is good looking is required for the entry level person for the digital marketing job, I guess. Then participation by those charged with governance. An entity's control consciousness is significantly influenced by those charged with governance. It's a top-down approach that we have discussed. So please remember this term and use it in the exam. This will definitely fetch you good marks. Control consciousness. This is a very good term that has been used in our study material. An entity's control consciousness is significantly influenced by those charged with governance. Do those charged with governance take control seriously? Do they themselves take control seriously? Do they exercise them stringently? And if yes, then there will be more chances of being followed by the employees, obviously. Are the responsibilities of those charged with governance important? Yes, the importance of the responsibility of those charged with governance is recognizing codes of practices and laws and regulations in the company law, etc. In the SEBI regulations as well. Their responsibilities include oversight of the design and effective operation of whistleblower procedure and process of reviewing the effectiveness of internal control. Management's philosophy and operating style. What is the management philosophy and how do they actually operate? This include a broad range of characteristics. For example, management attitudes and actions towards financial reporting may manifest themselves through conservative or aggressive selection. And how transparent are they actually in their financial reporting? Do they only show the rosy picture in their annual reports, or do they also tell the challenges that they are actually facing on ground? Are they very transparent with the investors through the annual reports and with the other users of financial statements, or are they not? Then the organizational structure. So the establishing a relevant organizational structure includes considering key areas of authority and responsibility and appropriate lines of reporting. So generally, organizational structure is considered the first component over here, but you should understand the intention of the study material, that even more than organizational structure, the intention, the communication and enforcement of integrity and ethical values, that has been put at the priority at the first point of the control environment, because this is that important. Then commitment to competence, participation by those charged with governance, management's philosophy and operating style. So all these intangible qualities have been put above the actual tangible thing, which is organization structure. So you should understand and appreciate their importance as well in this sequence. Then comes the organizational structure, which you are well aware of, considering the key areas of authority and responsibility and appropriate lines of reporting. So I have put in a case study over here that you can quote in the examples as well if this comes in the exam. So example is that in the early days of Amazon, Jeff Bezos instituted a 2-pizza rule. Every internal team should be small enough that it can be fed with only 2 pizzas. Only that small team is required. So this is regarding the commitment to the organizational structure and how it should be controlled. So this shows that the goal wasn't to cut down on catering bill. It was like almost everything Amazon does focused on two aims: efficiency and scalability. Amazon found that the biggest predictor of a team's success wasn't whether it was small, but whether it had leader with the appropriate skills, authority, and experience to staff and manage a team whose sole focus was to get the job done. The model was gradually refined and ultimately replaced by a far more capable type of team model, one still in use today. In time, two pizza team evolved into a single threaded leader team, a term borrowed from computer science that means to only work on one thing at a time. So this is nothing but just the commitment to the control environment, commitment to improving the organization structure over time. And this shows how this organization structure developed in the Amazon. This is one of the examples. This is just for your understanding, and this is not a part of study material. So sixth point is assignment of authority and responsibility. Then you have to assign after the organization structure. Once we have decided, then you have to assign the authority and responsibility. Policies related to appropriate business practices, knowledge and experience of key personnel according to that. Resources provided for carrying out duties, whether the resources have actually been provided to them to carry out their duties or not. In addition, policies and communication directed at ensuring that all personnel understand the entity's objectives, whether they actually understand and how their actions actually relate to those objectives. Accountability, how and for what they will be held accountable. So every employee should know what they are accountable for, what they are responsible for, and how their individual actions relate to the overall entity's objectives. Human resource policies and practices. Human resource policies and practices often demonstrate important matters in relation to control consciousness. Please understand that this term is being used repetitively, control consciousness, and you have to use that term in the exams to fetch good marks. For example, standard for recruiting most qualified individuals on educational background, prior work experience, past accomplishment, background checks for whether these people are ethical or not, training, timely promotions, all play part in control environment. So please understand that training, timely promotions, salary increments, these are also part of the control environment, and this is the environment that we set for the employees. So second is the entity's risk assessment process. So first was the control environment. Second is the entity's risk assessment process. In control environment, we have seen the communication and enforcement of integrity and ethical values, commitment to competence, participation by those charged with governance, management philosophy, operating style, organization structure, assignment of authority, responsibility, HR policies and practices. Do you have to remember this? Yes, you have to remember this. A short note may come in the form of that, please explain the control environment as a component of internal control, and then you'll have to write down these components, and then you have to quote some examples as well. Second component is entity's risk assessment process. So here I have shown the risk perception, risk analysis, and then risk management. So entity's risk assessment process includes how management identifies risk, estimate their significance, assess the likelihood of their occurrence, and decides upon actions to respond to and manage them and results thereof. So risk can arise. So risk, we have already discussed what is risk. Risk can arise or change due to circumstances such as, so it can arise and change due to change in circumstances. There could be some changes that could lead to higher risk. So for example, changing in operating environment. So regulatory or operating environment can change, and that could lead to higher risk. And example, introduction of tax breaks in competitors' place of operation that could improve the competitors' profitability, and may serve a big threat to new personnel. New personnel may have a different focus on our understanding of internal control, especially key personnel. If a key management personnel comes and he has a different understanding of internal control, then everything that was done until that day could go for a toss. This can arise due to change in circumstances such as the following. So we have discussed two: change in operating environment, new personnel. Third is new or revamped information system. For example, introduction of robotic information system or change the ERP system. This could bring a change in the risk assessment and the risk procedures. Rapid growth. So not just the loss-making entities are at the higher risk, but also the rapid growth entities are also at higher risk because of their growth only. So significant and rapid expansion of operations can strain controls and increase the risk of breakdown in controls. Many retail players opened numerous stores despite incurring losses, but DMart stuck with only profitable expansion and avoided loss-making growth and physical presence. So all the retail chains were generally what they do. As soon as they open one retail store, they plan on open the second retail store and so on and so forth throughout the country, and they end up making huge losses. Whereas retail chain by the name of DMart, they stuck with only profitable expansion. Only when one of their branches make the profit, then they expanded to the second branch and so on, and that's why they are profitable as on date. And this is how they avoided the rapid growth risk assessment. Uh, risk assessment. How they avoided rapid growth risk, and because they assessed the risk in the timely manner. New technology, incorporating new technologies into production processes or information system may change the risk associated with internal control. For example, new production lines for electric cars is changing the risk environment for producers even in India. So, third is new business models, products, or activities entering into business areas or transactions which the entity has little experience may introduce new risk. For example, change in business models of film producers due to COVID also, and with the introduction of OTT platforms like Netflix, Prime, etc. Now they have changed. Now the entire game is changed. Now their products offering platforms have changed, and their entire risk assessment procedure will change. Their entire risk scenario will change, and they will have to face the risk with the competition from the global players at one platform. Corporate restructuring may be accompanied by staff reduction and changes in supervision and segregation of duty that may change the risk associated with internal control. Expanded foreign operations that brings along with new regulatory environment and new competitor environment. New accounting pronouncements, for example, introduction of Ind AS, that could bring about new risks to the organization. Then, so now till now we have discussed this control environment, entities risk assessment process, control activities is what we have come to now. So control activities that may be relevant to an audit may be categorized as policies and procedures that pertain to following: performance review, information processing, physical control, segregation of duties. Performance review and analysis of actual performance versus budgets of the organization versus forecast versus prior period performance, relating different sets of data, operating or financial, to one another, together with analysis of interrelationships and investigate and corrective action. What are the interrelationship among different items of the financial statements, and if there is any huge deviation, then the auditor should investigate and what are the corrective actions that are being done. Comparing internal data with the external sources of information, and review of functional or activity performance. Information processing, the two broad groupings of information processing are application and GIT, that is general IT control. General IT controls are at the macro level, they operate at the macro level, whereas application controls operate at the micro level. Example of application control include checking the arithmetical accuracy of record, maintaining, reviewing accounts and trial balances. Automated controls such as edit checks of input data, numerical sequence, etc. These are at the macro level. And these are the application controls, and the GIT, which is at the macro level, is program change control that restrict access to programs or data, that is access restrictions, etc. Controls over implementation of new releases of packaged software application, control over system software restricted access, monitor to system utilities, etc. And then the maintenance of audit trail. Physical control should not be like this. Physical controls that encompass physical security of assets, including adequate safeguards such as secured facilities, over access to assets and records, Second is authorization for access to computer programs. So physical security also means authorization and access to computer programs and data files. It should be password protected, etc. The periodic counting and comparison with the amounts. Fourth is segregation of duties that we have already discussed in detail. That's why I was saying segregation of duties is very important, because it comes again and again in our discussion, and it is quite critical also to the internal audits, and that's why you should always keep it in mind with what is the segregation of duty principle is, what are its four components. For example, authorization controls may be delegated under established guidelines such as investment criteria set by those charged with governance. So in this, the authorization controls can be given to various people, various levels of people in a particular department. Alternatively, non-routine transactions such as major acquisition or divestments may require specific high-level approval, let's say CFO, including in some cases that of shareholders, that of investors. Now we have come to the information system and communication. So this is the fourth component of internal control. Yes, this is a very lengthy topic in components of internal control, but this is a very crucial topic as well, and you are expected to learn its components, especially the highlighted items, that highlighted words, highlighted keywords that I have mentioned over here, along with the examples, along with the relevant examples that should serve the purpose. And if during the time of revision you only go through the examples and keywords, that should be enough for you, and that would give you enough clarity and within a short span of time. So you can download this PPT from the ICAI website only, and I'll share it over there as well. So this would, and you don't need to refer anything apart from this. You can refer, obviously you can refer study material additionally, but nothing else. Though this slide is entirely based upon the study material only. Then we had come to information system and communication. Information system, consists of infrastructure, software, people, procedures, and data. Many information systems make extensive use of IT. So this might be little surprising for you, but not every information system make use of IT, and information system doesn't necessarily contain IT. But nowadays it has become synonymous with the IT, and information systems make extensive use of IT because of obviously because of the changes in the environment, in the business environment. The information system relevant, and more so in the during the COVID period, the information system relevant to financial reporting objectives, which includes the financial reporting system, encompass methods and records that. So this is what the information system does, and it may make use of IT or it may not. Identify and record all valid transactions. Describe on a timely basis the transaction in sufficient detail to permit proper classification. For example, if financial information is changed because of accounting software lags, it may lead to wrong financial statement preparation, wrong information to taxation departments, penalties, etc. So it should be on a timely basis, not that what I enter today would be reflected after 15 days in my accounting books. That should not be there. Identify and record, describe on a timely basis. Measure the value of transactions in a manner that permits recording their proper monetary value in the financial statement. Determine the time period in which it is recorded, present properly, and related. Communication. This is one of the parts of this fourth level of the component, information system and communication. We have discussed the information system. Now the communication, which involves providing an understanding of individual roles and responsibilities pertaining to internal control over financial reporting, may take such form as policy manuals, accounting. So through these documents, through these policy manuals, through these actions, actually, the internal control over financial reporting are communicated to various employees, various levels of employees, and this is also through the actions of management, which is the most important way of communication. So the employees will follow what the management will do, not what the management will say. This is the same. And this is very true because through its actions only, through its control consciousness only, the management directs the control consciousness of the lower level of management. this is what the employees will actually follow. So we have discussed information system and communication. We have discussed control activities, entities risk assessment procedure, and then control environment also. Now comes the monitoring of controls. After all these things, we need to monitor and maintain the controls as well, whether they are functioning properly or not. We need to see that. So management's monitoring of control includes considering whether they are operating as intended and modified as appropriate. I have highlighted this so that you can only remember this only and you will be sorted. Operating as intended and modified as appropriate for changes in operation. Monitoring is done also to ensure that controls continue to operate effectively over time. For example, management review of whether bank reconciliation are being prepared on timely basis. Internal auditors evaluation of sale personnel's compliance with the entity's policies on terms of sales contract. Legal department's oversight of compliance with entities' ethical or business practice policies. These are the examples to see whether these controls continue to operate effectively over time or not. Monitoring may use information from communication from external parties also that may indicate problems or highlight areas in need of improvement. For example, if there are regular delays in filing of returns, there are regular penal interest, fines, and penalties in profit and loss account, that will show that there's some internal control system is lagging, and we are not complying with the regulatory requirements on timely basis and incorrect manner, and that would show that the internal control system is faulty somewhere, and we need to monitor it and rectify it accordingly. So this is an example that we got from the external party. We got some notices of penal interest or fines or representation that the taxation. Also, management may consider communication relating to internal control from external auditors in performing monitoring activities. So statutory auditors may also comment upon that, and then by the bank regulatory agencies, etc., you may get the notices and you may get examination or cross-questioning or investigations from them, and that would point out that there is some lack in the internal control system, and that will help you in further monitoring of the internal control system. So now we have covered the components of internal controls. Since this was a very lengthy topic and I didn't want to interrupt in between, if any one of you has any question, I am open to questions now, and I'm looking at the comment section. You may please post your questions over there. I'll be very happy to answer them. You may ask questions now. Yes, yes, Rahul. Short notes may be asked on that. Whether the entire control environment can be asked. Yes, it can be asked. It can be asked, and you may be required to put it in brief, not in this much detail. And you may just go through the highlighted text over here to answer your question and give some examples. This might sound a little detailed because since I'm explaining you it in quite detail, but once you go through it on your own, you might not find it that detailed, and there are some unnecessary case summaries just for your understanding only that you can omit completely from your answer. So we'll move on to the next topic, which is internal check system. So internal check system is part of internal controls, and accounting controls have 2 points, 2 aspects: the internal audit, which we have discussed, and the second is the internal check system. The internal audit has been discussed in another lecture. Internal check system implies organization of the overall system of bookkeeping and arrangement of staff duties in such a way that no one person can carry through a transaction and record every aspect thereof. This is what I think Sumit was saying, or I don't know what the name of the student was. He was saying whether maker and checker concept. He was talking about maker and checker concept. This is one of the one of the criteria over here. This is one of the elements over here in the internal check system. Implies an organization of overall system of bookkeeping and arrangement of staff duties in such a way that no one person can carry through a transaction. This segregation of duty only. A built-in check-in system as far as organization and job allocation aspects of controls are concerned. The system provides existence of checks on day-to-day transactions. So this is not on. This is on the regular transactions that that this check provide. This internal check system helps in keeping a check. So the following are the objectives of internal check system: to detect error and fraud with ease, to avoid and minimize the possibility of commission of error and fraud by any staff, to increase the efficiency of the staff working with the organization, locate the responsibilities, to protect the integrity of the business by ensuring the accounts are always subject to proper scrutiny. For example, overbilling to clients leading to trust deficit. So, if you overbill the client leading to trust deficit, this will obviously compromise the integrity of the business. And how it is avoided? Through internal check system, on day-to-day transactions. Then to prevent and avoid the misappropriation or embezzlement of cash and falsification of accounts. The effectiveness of an efficient system of internal check depends on the following consideration. These are what are required for the effective internal check system: clarity of responsibility, division of work, standardization, and appraisal. So appraisal is not salary appraisal here, it is the periodic review. Clarity of responsibility means the responsibility of different persons engaged in various operations, and they should be very clear about the responsibility, what they'll be held accountable for, and the organization structure, the organization chart should be well integrated, and they should understand how their own work will contribute to the entity's objective, and what are they will responsible for. Division of work, segregation of work, rotation, job rotation, free flow of work, and one person task is complementary to the other. This we have discussed in this segregation of duty. Standardization is new over here. Standardization means standard operating procedures that the company set, and this could be for the routine activities, because internal check system operates over the routine activities. So, for example, for the bill payment, for the bill processing, there would be some standard operating procedure. And for the check deposit, check collection, there would be some standard operating procedure. So that standard operating procedure needs to be recorded and communicated to the relevant employees, and then that needs to be followed over period as well. Appraisal means periodic review to the changes in the internal check system and what of these SOPs. And then the audit flow chart should be prepared, keeping in mind that such processes and how the audit will proceed through these steps in a sequential manner. So this is the appraisal. So these are the four requirements for the effectiveness of the internal check system: clarity of responsibility, division of work, standardization, appraisal. Then general condition pertaining to the internal check system may be summarized as follow. No single person have complete control. This is segregation of duty. And every employee's action should come under the review of another person. Persons having physical custody of assets must not be. So above 4 points are related to segregation of duty discussion only. So I've noted that here also, but you need to remember them. After that, the financial and administrative powers should be distributed very judiciously among different officers, and the manner in which these are actually exercised should be reviewed periodically. So till now, we have only discussed about the allocation of responsibility and not about the allocation of power, whereas the power should be distributed very judiciously and very cautiously, and that should be reviewed periodically to see whether any breaches have been done, whether any overridings have been done on that, and whether it has been abused in any manner. Every member of the staff should be encouraged to go on a leave at least once a year. Budgetary control should be exercised and deviations observed should be reconciled. So the above point that every member of the staff should be encouraged to go on a leave once a year, this is a very important audit point as well. If you see that any employee is not going on a leave for for a year, you can question its authenticity as well, that and that should raise some doubts in your mind that whether that employees actually exists or not. And if that person actually exists, then you should ask the management to at least send him or her on leave, because you should also verify that whether everything is dependent on that person, and whether that person can be replaced or not, or whether that person has become that crucial, or he or she owns that much of responsibilities that work cannot be done without them. Then that becomes little tricky for the organization, and that there might be some segregation of duty issues as well. So that is a very crucial point for your practical audits as well. So remember this, that every member of staff should be encouraged to go on leave for at least once a year. And then budgetary control should be exercised and wide deviations observed should be reconciled for inventory taking at the close of the year. Trading activity should if possible be suspended. It should be done by staff belonging to several sections of the organization. This example I gave you in the limitation of internal control as well. And the procedure should be laid down for periodical verification and testing of different sections of accounting record to ensure they are accurate. So these are quite general conditions, but you need to remember these conditions as the prerequisites of internal check system, and as the name also says that these are the general conditions. So this could be asked as a short note from you in the exam as well, and give the general condition. And then you should also quote some practical relevant examples that we have been discussing throughout these presentations and throughout these lectures. So you should quote those examples as well. Review of the system of internal control. Now we are back to the internal control, and we are seeing how an auditor will review the internal control system. So an entity's system of internal control contains manual elements as well as automated elements. The use of manual or automated elements in internal control also affects the manner in which transactions are initiated, recorded, processed, and reported. Please remember these four processes of any transaction: initiated, recorded, processed, and reported. An entity's mix of manual and automated elements in internal control varies with nature and complexity, and the entity's use of IT. What are the conditions in which manual control may be more suitable to the automatic control? This question can be asked, and that's why I've highlighted this question as well. So it's a general perception that automatic controls are always good in comparison with manual control, but that's not the case. And this question can be asked, that what are the conditions in which manual control may be more suitable than automatic controls? So manual elements in internal control may be more suitable where judgment and discretion are required, such as following: large, unusual, or non-recurring transactions. Large, unusual, or non-recurring transactions, for example, merger and acquisition could be there, for which no automatic control can be put upon, and CEOs, CFOs, and other process owners will have to sit together. Investors will have to sit together and identify the way out for that, and see if it is any feasible or not. Then large, usual, or non-recurring transaction, for example, pricing specialized insurance products, like giving insurance to ISRO for a rocket launch. Yes, such insurances also exist, and for making those insurances, those specialized products, the automatic transactions cannot be done. Automatic controls cannot be applied. Circumstances where errors are difficult to define, anticipate, or predict. For example, implementing a new technology like blockchain under manual supervision of a technical expert. No automatic control can be applied over there unless it is of a regular nature. Generally, this is a general case. In changing circumstances that required a control response outside the scope of existing automated control, in which the circumstances are quite changing in a rapid manner, and then the automatic controls won't work over there. And in monitoring the effectiveness of automatic controls, so if you have to check the effectiveness of automatic controls themselves, then you'll have to do the manual checks there. So these are the cases where the manual control may be more suitable than automatic control. Please remember them. The review of the internal control system enables the auditor first to formulate his opinion that whether he can place reliance upon the internal control system of the organization so as to meet his audit objective A, to reduce the overall audit risk, and to B, to comment upon the truthfulness and fairness of the financial statements. So first is to formulate his opinion as to the reliance on the internal audits, then to locate the areas of weakness in the system so that the audit program and the nature, timing, and extent of substantive and compliance audit procedure can be adjusted. So, so to locate the areas of weakness in the system and define the nature, timing, extent of substantive and compliance audit procedure. Ambika is asking, sir, it seems that internal check system is same as segregation of duties, is it? Yes, segregation of duties components form part of internal check system, and above that there are some other components like we have discussed. So yes, segregation of duties are part of this internal check system that I have already told. Then, so we were discussing about the review of internal control system and why it is important for the auditor to form his opinion, to locate the areas of weakness, and determine the nature, timing, extent of substantive and compliance audit procedure. Example: if the internal control system over account receivable is weak. If the internal control system over account receivable is weak, then the auditor will have to change the nature, timing, extent, that is sample, of audit procedures. If store manager records are inconsistent or have lost in substantive audit procedures are required before putting reliance on internal controls in store accounting. So these are some examples. Frequency of review of internal control. This question may be asked: what should be the ideal frequency? If the auditor, because of his continuing relationship with his client, if the auditor is same and he's already aware of the features and efficacy of the internal control, he may just review the changes that have taken place in the intervening period. However, a comprehensive review in such case should be made at an interval of, say, 3 years. So within a period of 3 years, a comprehensive review of the entire internal control system should be done. When should the review of internal controls be done? Ordinarily, the review of internal controls should be undertaken as a distinct phase of audit before finalization of the audit program. So before you have actually finalized your audit program, you should review the internal control system. Please remember that these stages are very crucial for your understanding, for your basic understanding of the auditing subject and for your examination as well, because this could be the question. And I've seen many people who get confused in the timing of the internal control review and the frequency of the internal control review. Sometimes internal controls go unreviewed for five years and leading to many undesirable scenario in the audit and the organization. However, if the size of operation is rather small, the review can be undertaken in conjunction with other audit procedures and programs can be adjusted for any extension or elimination. So, internal control assessment and evaluation. Following are some of the key components to assess and evaluate the control environment. So, how would you assess and evaluate the key control environment? See, we have again come across segregation of job responsibilities. That's why I said that it was very important, and we'll come across it various times. So, through standard operating procedure, a well-defined SOP defines roles, responsibility, process, etc., and help clearly communicate the operating controls to all touch points of a process. This is a very important term, touch points of a process. The controls are likely to be clearly understood and consistently applied. Clearly understood and consistently applied during the employer term. Enterprise risk management, an organization's robust process to identify and mitigate risk, periodical review, identification of gaps, and taking effective control measures, segregation of responsibilities. So these are the key components to assess and evaluate control environment. Nothing new in this. Job rotation in sensitive areas. So please remember this, that job rotation in sensitive areas is very important. Any job carried out by the same person over a long period of time is likely to lead to complacency and possible misuse in sensitive areas. Complacency means self-satisfaction without any critical life. So that person might forget about having any critical eye on his own process and might become very self-satisfied, even though that process might be suffering from serious internal control issues and dangers. So to avoid this complacency and possible misuse in sensitive area, the job rotation should be done. And to avoid this complacency only, we have seen that example in which the inventory taking is done by the different department at the end, at the period end, and to avoid degeneration of controls. So for example, if the same buyer continues to conduct purchase function for a long period, it is likely that he gets into comfort zone with the existing vendors and hence does not exercise adequate control in terms of vendor development, competitive quotes, etc. So job rotation in sensitive area. Delegation of financial powers document. A clearly defined document on delegation of powers should be there. Information technology based control. With the advent of computers and ERP, it is much easier to embed controls through the system instead of being human dependent. The failure rate of IT embedded controls is likely to be low and have a better audit trail. You can go back and verify whether from where the transaction originated and where it ended and what was the documentation process in between. You can get the entire audit trail. And this is one of the important factors of the blockchain technology that you'll see in the coming years, that there is a complete audit trail in that, and any tampering of the audit trail is also recorded as another audit trail in the blockchain technology. So you'll see the use of IT-based controls more so in future, and is thus easier to monitor. For example, at the stage of customer invoicing, application of correct rates invoices or credit control can all be exercised directly through IT system providing control. So these are the key components to assess and evaluate the control environment: SOPs, ERM, segregation of duties, job rotation, delegated financial power, IT-based control. Questionnaire. So techniques. So until now we have discussed about the internal control assessment and evaluation, and in which we understood the key components. What are the key components to assess and evaluate? Now we come to the techniques. So there are a few techniques. One of them is questionnaire. Questionnaire, as the name suggests, is a list of questions, and the questions are set framed in an organized manner about each functional area, which has as purpose the evaluation of the effectiveness of control and detection of its weakness. Questions should be consistent, sequential, logical, and if possible, cooperative. So from whom these questions are being asked, by the way? These questions are being asked from the auditee, from the management, from the process owners. And these questions should be consistent, sequential, logical, and if possible, cooperative, and obviously professional. You should not ask personal questions on that. Obviously, these should relate to only audit. And a questionnaire usually consists of several separate sections devoted to areas such as purchase, sales, trade, receivables, etc. The questionnaire is intended to be filled by the company executives who are in charge of the various areas. The auditor or his representative arranges meetings with the executives concerned and get the answer. This is very important. So this was not used. This was not the condition of the questionnaire, that this meeting, but then this became a part of the standard procedure, because many a times the auditee doesn't get the intention of those questions, and many a times it becomes a to and fro thing, that the auditee sends some responses, the auditor points out certain further questions because the auditee wasn't able to understand the question properly. So it is recommended that the auditor or his representatives should arrange meetings with the executives and get the answers person to person or through Zoom meetings nowadays. And questions are so framed as generally to dispense with the requirement of a detailed answer to each question. So you do not need a detailed answer except in certain exceptional questions. Otherwise, only yes or no will work. Yes, no, or not applicable. And for this purpose, often one general question is broken down into a number of questions and sub-questions to enable the executive to provide yes, no, or not applicable form of reply. Yes, if it fits the plan of the good internal control. No, it indicates the weakness in the system. It is questioned like that. However, this should not be taken as an unbreakable rule. Of course, a question may be framed also as yes when answer would indicate weakness. But the general rule is that yes when it is a good internal control, no when it is a weakness in the system. So, for example, you can ask whether a periodic bank reconciliation is being done by the organization. If it says yes, then it means a good internal control exists. Then you might ask what is the periodicity, whether it is quarterly, monthly, or daily, or whatever. And no means that no, there is weakness in the system, and so on and so forth. So remember this, that these questions should be consistent, sequential, logical, and if possible, corroborative. Wherever it is necessary, slightly detailed answer may be asked to bring clarity to them. Can questionnaire be considered as official record and be documented as the audit document? Yes, it is part of the audit document. For the first year of engagement, issue of questionnaire is necessary. For subsequent years, the auditor, instead of issuing questionnaire again, may request the client to confirm whether any changes in the nature, scope of business necessitating a corresponding change in control system, or even without a change, the control system has undergone a change or not. Then take note of it and enter appropriate part in the question. But every third year, as was in the case of the earlier internal control review that we noticed, this should be a questionnaire must be issued. And then again, we have come across this control conscious and control consciousness. Please remember this. I'm again repeating this, that please remember this term. So what is the purpose of this questionnaire? It is to get the information, to gain the information, of course, for the auditing, to understand the unnoticed and unspectacular changes and that might have taken place during the intervening period. Also to make the client, to make the auditing control conscious. So these are the rationale for issuance of questionnaire every 3 years. Checklist. So this is the real checklist that I used to do in my internship days of finance and accounts. So one, we have dealt with the questionnaire. Second is the checklist. Questionnaire was in the form of question and checklist in the form of statements. And these statements, as you can see, these are for the auditor, and but also these can be for the auditee as well. So as you can see, note this is only guideline. It should not stop you from imaginative thinking, but it did stop us. So it is a series of instructions or questions on internal control which the auditor must follow or answer. So when a particular instruction is carried out, the auditor initials the space opposite the instruction, and it is in the form of question. If it is in the form of question, the answer generally yes, no, or not applicable. If the checklist is in the form of question, then it is nothing but a questionnaire. And a checklist is more in the nature of reminder to the auditor about the matters to be checked for testing the internal control system. A checklist which may be in the form of instruction questions or just points may be checked and may be meant for the auditor, staff, or the client, as it was for in my case. When the checklist is in the question form, it is hardly different from the question, as I've said. What is the difference between a checklist and question? Can this question be asked even? Yes, this question can be asked in the exams, and this would be the easiest question that you will tackle in the exams. What is the difference between a checklist and questionnaire? Questionnaires are generally directed towards employees of the auditee, whereas checklists may be directed towards audit team members as well. The internal check questionnaire incorporates a large number of detailed questions, but the checklist generally contains questions relating to the main control objective under the review. ICQ, the weakness are highlighted as the no, while in the checklist it is indicated by yes. The significance of no in ICQ does indicate a weakness, but the significance of the weakness is not revealed automatically. However, in the checklist, a specific statement is required where an apparent weakness may prove to be material. So simple. The third technique is flowchart. Flowchart you must have studied since your school times, but here it is little different because we are using it in the organization sense, and in the organization sense there are certain rules and symbols of flowchart. This is the symbol of flowchart that is being used in the study material. Whether this is a standard flowchart symbols. No, many organizations use different symbols of flowchart, but this is one of the criteria of making a flowchart, one of the way of making a flowchart that has been prescribed in the study material. So we'll concentrate only on this. And what is flowchart? A flowchart is a self-contained, complete and meaningful symbolic representation of flow of activities and related documents. So this is just the definition of flowchart, and you may see that what does flowchart do? Each one of the main functions to be linked with related function, and then it is for each and every department, and whether it should be studied for the department wise only. It should not be made into a hodgepodge of the entire organization flowchart, unless it is the organizational chart. Then it can work as that. Otherwise, you should study them only section wise or department wise, and then it should bring out the design gaps in internal controls. How we'll study a case study over here as well. And then it is a graphic representation of internal controls in section, subsection, and distinct from narrative form. It is not a narrative form. It gives a bird eye view, and one of the most effective ways of presenting the internal control in client organization. Use of questionnaire and flowchart. Generally, a questionnaire is also enclosed with a flowchart incorporating questions. This is an evaluation of control system through the process of flowcharting. These are simple points that you can go through on your own as well. So these are the symbols of flowchart. We'll see that a plain rectangle is documents, then the documents prepared has the shaded. If copy made, flow of documents is through arrow, flow of next step, alternative possibilities through fork. Dead end, A and D means alphabetically, numerically, or by date, permanent file of documents, serially counted, checked, and then this is temporary file. Attached, destroyed, initial, signs, book or ledger, posting source, keyed, explanatory, starting points. These are the symbols that you should remember. And a case study might be asked in the question, and you might have to bring out the gaps in the internal control system basis that, or you might be asked the same case study that is over there in the study material, and you just have to point out the gaps in the internal control system, the solution to which is also there in the study material, and that would be a little lottery for you. So first of all, we'll see here that that there are two sections over here: dispatch section and billing section. SD is supporting document. Dispatch section supporting document goes for 43214 copies, accounts, stocks, sundry debtors, and pre-numbered. CN is customer credit note. Credit note goes to customer. These all are pre-numbered. Then there is this billing section. In billing section, SA means sales advice. Sales advice goes 4 copies. Accounts, stocks, ESOPs, and then sale invoice is issued to customer. And these all are pre-numbered. And price list is there. So what are the gaps in internal control that we can see over here in the design flow? First is there is no system of prior credit sanction to the parties in the consequence. So in the dispatch section, if we see that there is no system of prior credit sanction, how much credit is to be given to whom, we have not seen that, and that may lead to bad credit risk. There is no checklist that all second copies of the sales advice sent by the dispatch section have been received by the billing section. So whether all that is being sent has actually been received by billing section, whether there is any reconciliation between them, we are not clear on that, and this flowchart doesn't say anything about that. There is no check in respect of pricing, extension, and addition on the invoice of credit notes. So when the credit notes are issued, there is no check on the pricing list, etc. And then there is no clear whether supporting documents are adequate. Well, in all these cases, whether the supporting documents are adequate, no one is checking that. There is no maker checker over here. So that's one of the weaknesses over here. So reporting to clients on internal control weaknesses. So as I said, that it is not enough that you just identify the weaknesses. It is also important that you report them, and that is the sole purpose of the audit, that you identify and report the material weaknesses to the clients. And material weaknesses, what are material weaknesses, are defined as the absence of adequate controls in flow of transactions that increase the possibility of error and fraud in financial statements. And the auditor should communicate such material weaknesses on a timely basis only. This communication should be through a letter of weakness or management letter. And by writing the letter of weakness, the auditor is not absolved. So here the case is that the auditor is not just absolving from his auditing responsibilities, but also he's not just actually fulfilling his auditing responsibilities, but he's also absolving himself from the legal liability that might arise in a later date if something comes up, if something legal comes up. So in this SP Chatterson and Limited, the auditor was acquitted. He was let go of the charge of negligence for employees fraud in the view of the fact that he had already informed the client about the unsatisfactory state in specific areas of accounts and had suggested improvements. So the auditor had done his work. Auditor had pointed out the material weaknesses, suggested improvements, but those were not acted upon by the management, and the management got tangled in this legal case. And so the auditor was let go of the charge of negligence for that. So this is the case that you must remember. And so by writing the letter of weaknesses, you are not absolved from his duty to report the shortcomings in the account by way of qualification. So just by writing this letter of weakness, you are not supposed to give a proper to give an audit report without any disqualification, without any disclaimer of opinion. You are required to report that in your audit report as well, that by way of a qualification where the defects have not been corrected to the auditor's satisfaction, being in the materiality. And it should be done on a timely basis. The letter of weakness should be done on a timely basis. It should not be that I identified this weakness 5 years ago and now please absolve me from the legal liabilities. That should not be the case. It should be done on a timely basis. Letter of weakness. What are the components of letter of weakness? Area of weakness and offer suggestions on improvement. That should be clearly stated over there. Only weakness which have come to the attention of the auditor as a result of his audit. And it should also mention that this examination has not been designed to determine the adequacy of internal control. That should be acknowledged in the letter of weakness itself, that this is only the weakness that we have come across, and this audit was not designed to determine the adequacy of internal control. This letter serves as a valuable reference document for management for purpose of revising the system. Obviously, this is a feedback mechanism for the management as well. The letter may also serve to minimize legal liability, as we saw in the SP Chatterson and Limited. Then standard of auditing 265, communicating deficiencies in internal control to those charged with governance. If the auditor has identified one or more deficiencies in internal control, he shall determine on the basis of audit work performed whether individually or in combination they constitute significant deficiency. And if it does, then he should communicate in writing on timely basis to those charged with governance and management deficiency. Those deficiencies are to be communicated which in the auditor's professional judgment are of sufficient importance to merit their respective attention. And this is not just for the sensationalizing the audit observation. This is actually some significant deficiency that merits the attention of those charged with governance, whose time is very crucial. And this standard of auditing does not impose additional responsibilities over and above the responsibilities of SF 315 and 330. Before communicating to those charged with governance, the auditor shall communicate to management, because those charged with governance are very senior people, and before communicating to them, you should communicate to management at an appropriate level of responsibility on timely basis. Wherever you have to use the word report, use the timely basis word as well. In writing significant deficiencies, discuss with the management in writing significant deficiencies that the auditor has communicated or intends to communicate, unless it would be inappropriate to communicate directly to the management. For example, if any fraud has been conducted by the management itself, then you would not discuss that with the management, or in any other circumstance which, according to professional judgment of the auditor concludes that this should not be discussed with the management and should be directly escalated to those charged with governance, then he should do so. And other deficiencies in internal control identified during the audit that have not been communicated by management by the other parties. So the auditor shall communicate to management at appropriate level of responsibility before going to those charged with governance. This is what this section says. So in written communication of significant deficiencies, what will the auditor do? Auditor will describe the deficiencies and their potential effects, and give the sufficient information in the context of that communication. And the purpose of the audit, that it was to express an opinion on the financial statements only and not to identify these significant deficiencies or comment upon the internal control system. The audit included consideration of internal control, only consideration of internal control, relevant to preparation of financial statement in order to design audit procedure, but not for the purpose of expressing an opinion on the effectiveness of internal control. Third, it is limited to those deficiencies only that the auditor has concluded are of sufficient importance to merit those reports. So what you have not checked, you will not report on that, and you will also say it specifically, expressly, that the deficiencies are limited to only those which you have mentioned in the written communication. Now there are frameworks of internal control. There are various frameworks of internal controls that are over there, according to which companies comply and maintain their internal control system and review it time by time. So one of them is the guidance note on audit of internal financial control over financial reporting, issued by the ICAI. So ICAI has issued a guidance note on the audit of internal financial controls over financial reporting, which covers aspects such as scope of reporting on IFC, that is internal financial controls under Companies Act 2013, essential components of internal controls, technical guidance on audit of IFC, implementation guidance on the audit of IFC. As there are accounting standards, so what is the purpose of this? As there are accounting standards against which truth and fairness of financial statements are evaluated, similarly, a benchmark internal control system should be there, against which the compliance and the system of internal control should be evaluated. So these guidance notes serve that purpose. In Indian context, students are advised to refer Appendix 1, Internal Control Components of SA 315, SA 315 provide the necessary criteria for IFC over financial reporting. So there you will find that benchmark. And what are you going to see in that Appendix 1 that we have already discussed in that lengthy topic of internal control components? That is already what is covered in the Appendix 1. So no need to worry about this additional appendix anymore. Then this was in the Indian context. Now we come to the international frameworks of internal control. One of which is FOSO. You must have heard about it. So this is integrated framework issued by committee of the sponsoring organization of the Treadway Commission. Do you need to remember this name? Yes, you need to, because a short note may be asked on this FOSO framework also. Integrated framework was introduced in 1992. Guidance on how to establish better controls companies can achieve their objective. So it categorizes objectives into basic principles, and the basic principles are associated with 5 components: control environment, risk assessment, control activities, information communication, monitoring. And these include some key elements for compliance such as integrity, ethical values, authorities, policy, procedure. So overall, these are the 17 principles that you need to, and that are relevant for every entity, and that you need to remember for the examination purposes. So control environment has these 5, and the risk assessment has these 4. Control activities are these 3. Information communication, these 3. Monitoring, these 2. Nothing is new over here. We have already discussed each one of them in detail, quite detail. And because our Indian standards cover each one of them in quite detail, our standards on auditing are quite exhaustive and related to internal controls, and they are quite well articulated over here. So, and then comes the framework lists 3 categories of objectives as below: operation objectives, reporting objectives, compliance objectives, limitation of internal control. We have discussed all of them. Operation objectives, effectiveness, efficiency; reporting objectives, internal, external, financial, non-financial; compliance objective, compliance with laws and regulations; limitation of internal control. We have discussed that in detail as well. Now, an effective system of internal control recognizes their inherent limitations. So, internal control system should recognize its inherent limitation and addresses the ways to minimize by good design and implementation. To provide reasonable assurance, not absolute assurance, the entity will achieve its operating, reporting, and compliance objectives. So these are the framework also that you need to remember. Then there is another framework called COCO, Canadian. This is issued by the Canadian Institute of Chartered Accountants, and this was also introduced in 1992. But in 1995, guidance on control was produced, and COCO framework was made. 20 criteria for effective control in 4 areas: purpose, commitment, capability, and monitoring. So these are just the different classification of the same, of almost the same principles. So these are the four areas: purpose, commitment, capability, monitoring, and learning. In order to assess control, whether control exists and when operating effectively, each criterion must be examined to identify the control and in place to address. Then there is a COBIT. COBIT is only for IT, and it is a framework created by ICAI for IT governance and management. So COBIT has 34 high-level processes that cover around 210 control objectives in 4 domains: planning, organizing, acquisition, implementation, delivery, support, monitoring, and evaluation. This is quite important. This COBIT is quite important, and because of the data privacy issues, this has become quite important across the globe, and companies across the globe follow this framework to manage their information system with security and internal control. Business managers are equipped with a model to deliver value to the organization and practice better risk management practices associated with IT processes. It is a control model that guarantees integrity of information system, and it is used globally by all the managers. COBIT ensures quality, control, and reliability of information system. I hope I'm not sounding like anyone who is selling COBIT to you. This is what is required, and this is what is actual benefit of COBIT. And how to use IT resources, application, information, infrastructure, people, and IT domains, and so that there are availability, reliability, efficiency, confidentiality, integrity, compliance, effectiveness, etc. And for example, to avoid downtime of bank branches and your favorite social media, well-governed IT practice can assist businesses in complying with laws, regulations, and contractual arrangements. So these are the requirements of any IT company or any company that operates in a technological environment, and COBIT has become an essential information security framework for them. Then there is a Turnbull report, which is also which is guidance for directors on combined code, published by the Institute of Chartered Accountants, England and Wales. The key principles of the code are enunciated as below. The board should maintain a sound system of internal control to safeguard shareholders' interest and company's assets. The directors should at least annually conduct a review of effectiveness of internal control. Not just conduct a review, but also report to shareholders overall controls, including financial operational compliances. Companies which do not have internal audit function should from time to time review the need for one. And the guidance required directors to exercise judgment how the company has implemented the requirements of the code. The guidance is based on the adoption by company's board of risk-based approach and establish a sound system of internal control. This should be incorporated by a company within its normal management and governance process. It should not be just for the compliance purpose, and it should not be just to treat as a separate exercise and to make regulatory requirements and make it inherent. So we have come to the inherent. That was where we started. Then there is SOX, which is Sarbanes-Oxley Section 404, mandates that all public traded companies must establish internal control procedures for financial reporting, document test, and maintain controls and procedure. It is the sole purpose of SOX is to reduce the possibilities of corporate fraud, and it was actually introduced on the wake of as the aftermath of when the dot-com bubble burst and corporations faced frauds. It was a law signed in 2002 and publicly traded companies, corporate governance and reporting obligations. So, SEC rules, that is Security and Exchange Condition Rule, and PCAOB standard required. PCAOB is Public Company Accounting Oversight Board. A formal assessment of its control over financial reporting, including test and confirm the design and operating effectiveness. Management must include in its annual report an assessment of ICFR. And external auditors should provide 2 opinions: independent opinions on effectiveness of the system of ICFR and traditional opinion on financial statements. For the purpose of Section 404, use the definition of POSO's internal control integrated framework only. Management needs to determine whether the system of internal control provides reasonable assurance and either interim or financial reporting will be prevented or detected. The rules issued by SEC require companies in annual report to include an internal report of management that contains what does the annual report of management must contain in the annual report: a statement of management responsibility for establishing and maintaining internal controls, a statement identifying the framework used by management, and effectiveness management assessment of the effectiveness of company's internal control at the end of completion company's most recent fiscal year, and report whether it is effective or not. The assessment must include disclosure of any material weakness. They have to identify the material weakness, and the management is not permitted to conclude that it is effective if there are one or more material weakness. If they have identified material weakness, then they are not permitted to conclude that its internal control over financial reporting is effective. A statement that the registered public accounting firm that audited the financial statements has issued an attestation report on management's assessment. So the auditors in US are required to get registered with PCAOB, and the annual report must contain the statement that the registered public accounting firm that audited the financial statements included in the audit report has issued an attestation report on management. So management assessment is attested by the auditors as well. And the final rules require a company to file as a part of its company's annual report the attestation report also. So that's all for the lecture for today. Hope you have understood it. Thank you. Have a good day.
Thank you so much, Saurabh. Thanks a lot for this wonderful session. Students will be sharing PPTs, all the PPTs with you, and it will be uploaded. And please study carefully. In case if you remain, if you have any doubt, you can come back to us. You can write a mail to us on auditing-final@icai.in. In case if you have any of the doubt, any of the query, you can write to us. I'm repeating the mail ID: auditing-final@icai.in. And have a great learning experience, and please study carefully, practice with revisionary test paper and mock test paper. Wish you all the very best. Thank you. Thank you, Saurabh, once again.
Thank you, ma'am. Thank you.
Much.